Hi, good morning. Welcome, everybody. My name is Jen Kreider. I'm the Chief Executive Officer of PICPA, and I'm so excited to welcome you today to PICPA's 12th annual Q&A with the IRS. I'd really like to thank Rich Furlong, the IRS Senior Stakeholder Liaison, for being here with us today, and also our special guest, Frank Breslin of the Philadelphia Department of Revenue. I'd like to thank Jay Brower, a partner at CBiz Marks Paneth, and also Matt Mellinson, a partner at Grant Thornton. They're here today to talk about state and local tax trends. We're always glad to have them on board. And finally, I'd like to thank Karen Facer-Me of Facer-Me and Associates for chairing this Q&A with the IRS subcommittee and helping pull all of this together. It's lots of work and lots of people pitch in and help. So thanks so much to everybody who puts this important program together. We're looking forward to your feedback as we continue to plan content in this space. So please share your thoughts on the evaluation after today's conference, so that we can continue to improve it. I have a couple of housekeeping announcements to go over before we get started, so bear with me and then we'll jump right into the programming. So first of all, course materials, participant lists, certificates of completion. I know we all worry about getting those certificates at the end. So you can log onto your account at picpa.org to access conference participant rosters as well as the materials. Materials are also available in the handout section of your screen during the webcast today. So if you want to grab them from there, you can. We'll post the recording of today's program on PICPA's website, and we'll share the link with you when it's all ready. And finally, certificates of completion will be available under your CPE History tab within 5 to 7 business days. With regard to attendance checks, please make sure you're clicking on all attendance check pop-up boxes during the conference. You must click on at least 75% of the boxes during each individual session to receive full credit. Make sure that your pop-ups are enabled to make sure that they appear. And if you're attending the webcast as a group, please complete your group attendance form and return that to us. All of today's speakers are live here with us, so they are available to take your questions throughout the program. To ask the speaker a question, use the Ask the Moderator panel on your screen. If you're looking around, you'll see a box entitled Ask the Moderator. That'll go right to the speakers in real time. And if they're able to, they will take your questions live throughout the program today. You can also ask the PICPA staff for technical support in the Ask the Moderator box, and they'll be able to help you there as well. Finally, you're able to chat with fellow attendees throughout the day using the peer-to-peer chat box. So 2 different boxes. Ask the Moderator will go to the speakers. Peer-to-peer chat is chatting with other attendees for the program, sort of like if you're in the hallway, if we were live and wanted to talk to somebody about something. Next, I'd like to thank Total Technology Resources for their support of today's conference. Karen Facer-Me will spend some time later today addressing how they can help your business through technology support. So you can learn more about them in the meantime at thetechresource.com. Lastly, just one more reminder to please tell us what you thought about the program. Complete the conference evaluation, which will be sent by email at the conclusion of the conference today. So that is all for my announcements. We're excited and ready to start the first session with Richard Furlong and Karen Facer-Me. So Karen and Rich, I'll turn it over to both of you. Thanks for being here.
Thanks so much, Jen. This is a great course every year for every practitioner, every firm. I appreciate everybody taking the time, and I promise to you that we will certainly make it well worth your while during tax season. We have a committee that is together behind me that has helped with some of these slides. You may think it's very different than any other course, probably because you'll look at the resources. They may not be pretty, but they're giving you what you need. And we're doing it the last minute. So what I've done in the past, including this year, is poll different firms. So if you do get a phone call from me or somebody on the committee, we appreciate you taking your time to find out what your firm needs. What are important last minute things before tax season. We're kind of the gap between the fall courses and what's happened in the month of December and January. So even though we're giving you tons of material, when we have a question, we'll look into it. And that's why it really helps for you to give us questions in advance. So we do appreciate those firms that have helped out on those types of things. But I do want to also make sure that you check out your my account on PICPA and download the rest of the resources. In the box, you have items B, C, D, E, F. It goes from A to F, all the items that are on there. So they may not be in the box. So you want to go to your My Account and download every resource. I have IRS separate, I have Pennsylvania separate, and I asked PICPA to post Philadelphia separately because, for instance, on Pennsylvania side, there's an entire 8-hour course of slides that you can go through. I'd love to go to that course, but I don't have 8 hours at one moment to sit there and take it. If anyone has questions, I do have the actual speaker slides I'm not allowed to post, so I may be able to answer a question on a slide. So there's resources from the city of Philadelphia and also from the IRS, and they're separate from mine because what I do is I take the questions, answer them. Some of them will be answered by Richard in the course, and others I've expanded on in the materials or won't be answered. So, you're going to see a little duplication there, but, we're moving fast. The key is here that we're not going to go heavily into a topic because we want to hear from Richard. And the most important thing now is delays. So because of that, there are hot topics and in the materials too. But the most important part, I think, is the guide to the AICPA that AICPA did for the tax advisor. And basically what that guide does is it does give you what you're going to do if you have a delay in receiving your 1139 or 1045 response. Send a check for $1 with the forms and apply the check to the tax period of the amended return with a cover letter. There's a phone number for releasing liens. I've used that. I went through and interviewed people at the e-services desk. Tell your clients, go ahead and use a credit card. Don't use the mortgage, because if you use a loan number, they're going to have to, you should download an Experian report unredacted, because everything has to match for the IRS. And these are the issues people are having, and it's taking a long time. But, my advice to you is do your research first. Make sure you have power of attorneys on everybody. I don't send them into the IRS, but I have a power of attorney for every client. So if I need it, I can do it. But the key is we have to be more prepared than ever, because we have to survive. And even though the IRS tells us to wait, we know that we can't in many instances, because we have to protect taxpayer rights and people can sue us. So, this course is one of those things where you're going to get the inside scoop from Richard. You're going to get the inside scoop from other firms. We share this information. We're not competitors in that respect. We all have to live. We all have enough work to do. But basically, there's issues on there for professional liability that I want everybody to know about, because interviewing those insurance agents are scary. There's deals that we don't have the information from IRS or from the SBA when we were dealing with PPP loans. There's a lot of open issues. So the key is document everything with your clients. Let them know. My clients were so great last tax season because we prepared them. We had I had a special letter, for instance, on EIP that explained to them what was going on. So I think as long as you keep them in the loop, they understand what you're facing, and you're not going to have the stress, and they'll give you better information. But they're the kind of tools that we've included in this information, so that those resources have it and you don't have to track them down. So there's, it may not be as organized as I would have liked, but we're getting even information up to the day before. So you want to check it all out. At your very end, which I think is very important for tax practitioners like me that are subject to peer review, that still do financial statements, I asked Jim Newhart, who's on ethics and A&A, and he's going to be manning the chat to answer questions today to help us out, because we figured there's going to be a lot. Basically, I gave Richard 10 pages of questions with the answer. So he's going to try to hit all of those. So they are all filtered in. All the questions you sent ahead of time are filtered in. There's a couple client-specific ones that we'll deal with later. But the key is for those people that have peer review, the hot topic, which hopefully you know about, is that they about this third-party reviewer. They don't want it as self-reviewed, on your manual. So we've always had Kreischer Miller, my old firm, review our financial statements and help us with that. So it just seems like that's kind of the area. Luckily, we have Allison Henry kind of pushing back on that, but it's very expensive for small firms to try to do these things. So I see Richard's moving me along with my slides. And basically that's what this course is all about. Advocacy, hot issues, and resources. There's some items here that we should know. One of the things that I was surprised that most people didn't hear about was the FinCEN rules for BOI reporting. Luckily, my attorneys have, they know about it, but that goes into effect. It was passed on December 7th, and it's really going to affect a lot of our small clients. It's not targeted against the big clients. They can get out of it because if their sales are 5 million or there's 20 employees, then they don't have to report. But it's really designed, the idea is good. I just think that the implementation is going to be difficult for small people, for small firms. So, but the comment period closes on February 7th. So, contact attorneys to comment for you, make your complaints aware, or you're going to be stuck with it. But they really need to do this. If IRS is going to clamp down on tax evasion, they're going to need this tool. But it's going to be a pain for our clients because you have to determine, who's a beneficial owner. You have to do aggregation rules. There's a lot involved here, but it's domestic and foreign corporations, LLCs. It's going after the mom and pops, and it wants disclosure of who owns them. And the difficult part is if you make a mistake, it's better to file. There's penalties if you don't file. So, that's a real issue that I think we only see our clients once a year. And the reason I put it in here, it probably won't, you have a year to report, but it probably, we don't know the date yet when that's going to pass. And you want to warn your clients about it because new companies have to report within 14 days. So, if your client has heard this in the background, at least you're kind of off the hook that way. It's not an IRS form. It's a FinCEN form. But as you know, the FinCEN forms, the penalties are really, really excessive. So what information is on the FinCEN? What you're doing is you're reporting the company, the owner, and you have to provide identification. So it'll be not only the legal name, the birth, the current residential address, but they want a scanned copy of identification, like a passport or a driver's license. So it's going to be something that's going to be onerous, but it's not going to be too difficult to get a hold of for our small people. It's just one of those annoying things that you're going to have to put on the due date list and make sure that they do it, or they hire you to do it, or make sure you exclude it in your engagement letter so that you're not responsible for penalties. That's the key. But penalties for failure to file are $500 for each day of a violation up to $10,000. So our small clients really can't afford to do that. So you do want to make sure it's aware, keep it on your radar, and it's something ahead of schedule for next year because we don't want to get into 2023 and find out that these things should have been filed. So the next thing would be hot topics. The good news that Rich answered my concern was 8879s. A lot of us have those hanging around from 2020 where we did the returns, but we had to wait for IRS to open the e-file window. So they do it every year. I'm not used to filing any late returns, so I'm not watching that. Mine are in by October 15th. But IRS, it's not something new. They closed down, around Thanksgiving and then reopened back in January. But these 8879s, we don't have to track these people down because if you were like me, I sent them out by DocuSign when the people had the tax returns and then they sent back the 8879s like they're used to. I didn't want to tell them hold the 8879s. It's like, do it the way we normally do it. So basically, we don't have to get those re-signed if those people are, are subject to the disaster relief. And basically, those are the ones that had an issue and it was declared by FEMA that they're in a disaster zone. And because of the, because Trump treated COVID as a disaster, it's not a problem either. So basically, if the client was an IDA impacted taxpayer, Richard said we don't need another one. If they weren't, we are going to need another one because, as you know, once we get assigned 8879, we're supposed to e-file within a 3-day period. So that's why a lot of that information I've put in resources. Yeah.
Just let me know when I can jump in.
Oh.
Can you hear me?
Yeah, I can hear you.
Yeah. So first, good morning, everybody. I think so let me just give a little background on myself, and then I'll come into the IDA returns and the 8879. I do speak pretty quickly, but I'm a piker compared to Karen. She can go through a ton of material in a short period of time. So it's great to be back with you today, although I do miss that wonderful breakfast out at Spring Mill Manor, which is one of the best. But I think we do have a lot of interesting things to discuss today, and we'll get into them in a moment. For those who don't know me, I am in the Communications and Liaison Division of the IRS. I'm a senior stakeholder liaison, one of about 75 around the country. And the relationship between me, representing stakeholder liaison, and the Pennsylvania Institute of CPAs is an extremely important one. I did have an opportunity to speak briefly last month with Jen Kreider to get to know you conversation. I'll be meeting with the Federal Tax Committee for the first time in late February, and I think Karen will be at that meeting. And then we'll try to have those meetings maybe a couple of times a year. So I do work with your governmental liaison staff, and many of you do know me. Many of you email me on occasion. In fact, some may be waiting for email responses from me. Some may be, I know some familiar names are attending today. And as we get into the IRS portion of the program, a couple of caveats here. If you're reaching out to me, we are still working remotely. I'll get into what the government is trying to do to recall more employees to their offices. So if you're reaching me or attempting to reach me, I discourage you from leaving a voice message on my voice message on my telephone. It's easier to email me a succinct question. There are a couple of questions already in the text chat that are client specific. And while sometimes I can discuss those, particularly if they involve IRS correspondence, I ask that you refrain from sending me any client information unless I request it. We call that personally identifiable information, or PII. But on occasion, I will request maybe, and I'm always open to seeing a redacted copy of a CP note, of an IRS notice that can help me. And also, if you are representing a client or dealing with an IRS correspondence of some sort, or haven't heard back from an IRS agent with whom you've been dealing, it's helpful to me to have that conversation with you at a mutually convenient time, because my schedule, like yours, will be very busy during tax season. But I'm always open to that. And sometimes I get emails from PICPA members literally years after they've begun a exam or collection matter. And that can make it very tricky for me to respond, because so much may have happened in that engagement that options are limited, whereas options are less limited from the outset. So we'll come back to some of those themes going forward. Now, with regard to IDA, so when we, as Karen notes, around Thanksgiving, we put out a quick alert, which I encourage all CPAs to subscribe to quick alerts if they do anything electronically, filing information returns, filing business individual returns, because quick alerts is where they make that annual announcement shutting down the 1040 platform for reprogramming right around Thanksgiving. So this year, for the first time, as a result of IDA in Southeast Pennsylvania and New Jersey, I did hear almost immediately, probably within a couple of hours, Karen, a couple of PICPA members emailed me and said, does this mean I'll have to mail in the 1040? And at that time it did. And finally, somebody in the IRS, and I don't take credit for this, but someone got to IRS and said, well, for those IDA impacted taxpayers who did have a valid extension on file, and that's the key here. You'd have to have a 2848 or a 7004 processed by the IRS if you were filing on extension. But then they persuaded the IRS to move back the extended due date for filing to February 15th, a week or so. And I do want to give a shout out to Jay Brower, because when we put out the news release, and I didn't write that news release, the first one, but Jay picked up almost immediately that it indicated that there might be, that it would impact 2021 estimated payments. And we corrected that within a couple of days of Jay contacting me. We heard from other CPAs, but people like Karen and Jay and others on the Federal Tax Committee, they have a direct line of sight to me if they are hearing noise, or we call it buzz, on your listservs. And I, within Stakeholder Liaison, am on a cadre where we have our own SharePoint site, where we can, if I'm hearing buzz, and to give you an obvious example, this past week, we were hearing buzz on the FIRE system, the Filing Information Returns Electronically platform, that was running slow, and many FIRE users could not get through. We had many practitioners around the United States raising concerns. So I just want to level set expectations there. I don't get involved in specific case matters, but in many instances, if I fully understand the fact pattern, what I can do is tell you what I would do if I were sitting in your shoes. So again, Ida, you have until February 15th, but Karen, as I mentioned to you, if you file let's say a 1040 for a client who lives in a zip code, or have their books and records in a zip code impacted by Ida, by the federal disaster, and then they get a late filing notice, first, I'd like you to make sure that the extension was processed by the IRS. Now, if you electronically filed it, you would know the day you filed if it were accepted. But if it weren't, and if notices are coming out, before you respond, let me know. Give me the CP number, the notice, but you have to do your due diligence to help me to ensure that extension was processed. Would you agree with that, Karen?
Yeah, but I went a step further because I wanted to be more proactive and not have to bother you. I called the disaster line and, try to, those guys are on there for disasters, and they can put a note in the client file to match that to avoid a notice, they told me. So that's what I did with my clients, that the zip code doesn't match up to a FEMA code. But first, do your homework. I had the FEMA code right there, so I didn't want to hold those guys up. I know you should only discuss disaster items with them, but they were great because they put it and I'm hoping to avoid that, because certainly my Florida clients, are probably not going to come up on the disaster code. So, because their records were with me during the disaster, then they should be covered. So we shouldn't have a problem. But, if they don't, I certainly will reach out if it doesn't work. But that's the thing. I think we all need to be proactive so we don't get the notices, because we can't count on the on the IRS doing that. Just another reminder, those people that didn't take PPP expenses, I was one of those ones that always extend and wait to find out if we get regulations. So I deducted mine, but the people that filed early, where their clients forced them to do that, don't forget to take that this year. Use the safe harbor to deduct the 2020 expenses on 21, because it's, but it only applies to the first draw, not the second draw. So the next thing I wanted to remind you about is, don't forget about Code Section 139, disaster reimbursements. We did have a disaster here, and it's very unusual. My California clients are used to disasters all the time, but we're not. So a lot of our employers were very hesitant to do this, but it was a really great time to reward your employees for sticking it out. So, they could help them reacclimate and pay for, items to make sure that they could, deal with their family, funeral expenses, those types of things. And don't forget Form 982. There's a lot of our clients that are closing out businesses. A lot of people retired. A lot of people couldn't make it. So you don't want to miss that election, because it does need to be filed with a timely filed return. So I put all the details in there, so you don't want to forget that. And like I said, there's other details. The other thing I wanted to warn you about is the 2022 Venmo. IRS changed the reporting requirements for 1099Ks. So it used to be $10,000 or 200 transactions. but now it's down to $600. So a lot of our Schedule C
Karen?
clients, which have a hard time reconciling. Yeah.
Just
Yes,
a,
Rich.
a slight correction. It wasn't the IRS, it was Congress that lowered that threshold.
Congress, you're right. You're right.
So we have
we
to
don't want to blame the
administer
IRS. It's really Congress. Yes. So basically, even for your own self, if you have a business, you need to turn on the purchases, turn that function off so that you're not accidentally, or your clients are not accidentally getting a 1099 for a personal reimbursement. And you have to start that now, because the 1099s for 2022, you don't want to be reconciling them. So basically, my advice for you this year is very similar to last year: how to cope with the tax season. You have to modify clients' inspections. You have to ask everybody for help. Invest with your clients, take time with them to train them, try to do as much as you can, and value bill and let them know. I mean, I even had some, I was so busy, I said, well, send me, and I don't have a chance to bill. And they were sending me more money than what my time was. So PPP loans, we got a lot of, a lot of people that were very happy with that and understood that this was key. They couldn't have survived. Businesses would have closed without those loans, and had, quite a few people tell me that. So they do see our value. This is the time we need to capitalize on it and keep going, and tell them they need to help us with the bookkeeping. Let us do the complicated stuff on the tax returns to get us the right information. So we've given you a lot of materials to get that. How to keep updated on IRS delays is a key thing. But the other thing too is, say you run into trouble. One of the things with this course is you can see people's names on here, the firms that help. Reach out to some of the larger firms to have your clients hire them, or you hire them temporarily, or even like the payroll services. I reached out to Paychecks. I have a client, they qualify. They didn't think they qualified for an employee retention credit, but Jay had a good idea. He said, you don't want to amend that return. So we're going to reach out to Paychecks to do that. So even if you want to use Paychecks materials, they're all in there. So it's all organized for you. So you don't have to reinvent the wheel. Somebody else has done it. But like I said, the key things in the materials, and what the materials are mostly on, is how to keep updated on IRS delays. And there's a newsroom there. You can tell your clients to check that out so they can see how frequently. Hopefully the IRS will update it more frequently than they did before. I love the Surgeon's Weekly Expert Hour. So, every week I'm updated on things. AICPA, the town halls really saved us this year with PPP. It was wonderful. So PICPA, Peter Kakara does a great job on legislative alerts. So there's a lot of information, how to get accurate EIP from clients. I gave you ideas in here that I used last year. I didn't have one letter because I was making sure that before we filed that tax return, there was an engagement letter. Those people were signing off. They knew they had to pay extra if they didn't give me the numbers. That I had that additional addendum. I had sent them, a link how to do this yourself, or you can hire us, whatever it is. I don't want to file a return unless I know that number is right. So, please go through. Like I said, I already touched on the malpractice issues from IRS delays. We have, that's another reason I love to have Rich on here, because then he sees our side, what we have to deal with. Our insurance companies or our advisors are telling us, we don't care about delays. It doesn't matter. That doesn't protect you. You need to document and do what you need to do to protect taxpayers' rights. So, the key is show that you did something. Mail things certified mail. Don't do things twice. Rich is right. You're never going to solve things, but at least document it and do it right the first time. So all that information is in there. Like I said, the new resource, A Guide to Dealing with Today's IRS, is going to give you, it refers a lot to the Internal Revenue Manual. So I think that's an excellent resource. And then I added quite a few in there. I don't know if anybody's at controversy work, but that's one thing I do tell you: reach out to other people, because when you're dealing with the IRS and you have controversy work, everything's timed. So for instance, if you need to go to appeals, you should order that administrative record, and you need to know what to order. In the materials, I've given you all that, how to do that, what you need to ask for, the timing. And then mostly, it was great. Eliana, she made all the links live, and she checked all the bad links in our materials. So hopefully all that stuff works. We went through all that, and that's what's nice about having PICPA as a partner in this course. So you have a lot of resources. I hope you can use them. I apologize. We always get them out to you, like the day before, but that doesn't mean you have to do them before the course. Most firms, use them the rest of the year. One topic that I did talk to Rich about that I wanted to mention is that some of our members have signed up for NQ. It's a 1040 assist. It's a subscription service to give them preferential treatment when the IRS calls. So are these companies flooding IRS with robocalls? I don't know if it's making our situation worse. What do you think, Rich?
Well, let me address ENQ. We'll get into the functioning of the toll-free lines in a moment, but this ENQ company did create buzz again on that internal listserv that I and my colleagues track, and it got to the point where there have been some articles. I mean, you could Google or Bing ENQ and see some articles in the non-tax press on this country. The National Taxpayer Advocate weighed in this week. She has a blog, which I recommend subscribing to. It's always of interest. And she commented that this company made, which is basically robo-dialing until they get into the queue on behalf of the client. And then apparently they alert the client that you're in the queue, let's say for the practitioner priority service. Now, having said that, the call volume that IRS is about 15,000 customer service reps. And in a normal year, while you can have normal being pre-COVID, so pre-2020, there would be wait times, there would be spikes in traffic. ENQ's been around for a decade. And so I don't personally, although we have been asked by Congress whether or not and there are some competitors who do this, and they do it for I guess they do it if you're calling Social Security also, and other government toll-free lines. IRS has not responded publicly as to how significant this is to the phone traffic. I personally don't think it's the major cause. I haven't spoken to any PICPA member, Karen, at any length, who pays the fee, and they have a menu of fees depending upon what you want from this company. But I have not spoken to any, and I would be very interested in speaking to a PICPA member who does pay a monthly fee to see if it's value added to their practice. I think you'd have to be doing a lot of that controversy work, exam collection, appeals, to make it worthwhile. But with regard to the phones, and this was commented by the Advocate in her blog this week, IRS is attempting to we're hiring across the board. We're hiring tax attorneys to pursue tax shelters. We're hiring revenue agents, revenue officers. But the real problem for the IRS, even when more lower graded employees are brought back to the offices to handle the paper submissions and the toll-free lines, is that in this environment, in the economic environment, these entry-level jobs for customer service reps, which pay about, I think, around $40,000 a year, but they do have good benefits. We're competing with fast food outlets. We're competing with retail, all of whom are begging for employees, as we see in the economic data. And this was commented again by the Advocate this week. They haven't figured out what they're going to do, Karen. They would like to have many more people trained. So this filing season, while now I think it's 1 out of 5 calls are getting through on the first attempt, whereas last year it was 1 out of 10. They did add a big call site down in Puerto Rico, which picks up some of the phone traffic. They can reroute phone traffic around the country. It's going to be challenging at times, and sometimes. So I don't want to be Pollyannish here. It will be challenging to get through. But having said that, and we'll get into this when we get into the Q questions later, Karen, I very rarely recommend to any tax professional handling any IRS notice matter of any sort, that your first response is to craft a letter to be signed by the client or you if you have a POA and send it in. Because as the advocate has said, paper is the IRS kryptonite. She said that in the blog and in the report. And this is again, someday when the Treasury Inspector General and the General Accountability Office, GAO, do their audits of IRS operations over the past 2 years, the full impact of sending everybody home in March of 2020 for a couple of months and letting all of that a year and a half ago, that paper pile up to the point where late in 2020, there were over 12 million pieces of mail that at that time had not been opened. And then as it was open, getting into that mail and then having really the warm bodies to deal with it. I mean, you can scan those. People that aren't aware that you can scan, and we do use scanning technology to scan tax return, paper returns, and correspondence, and then it has to be routed and the majority of the people they're routing it to are working still remotely. They were set up for telework. So right now, Congress, this issue of IRS operations at the service centers as we get into filing season, it's not only this PICPA, the AICPA looking at this, and not only consortiums of tax pro organizations writing letters, but right now it's the Congress and the Treasury Department and the White House working with the IRS leadership, the commissioner and his staff. How do we, ensure that the 2021 returns coming in are processed? How do we ensure, to Karen's point, that we minimize math error notices where the due diligence that Karen admirably describes, she did, and will do again this year, to ensure that if you're claiming the recovery rebate credit on line 30 and or the child tax credit on line 28, that you have done your due diligence in insisting that the client provide you that documentation, showing those letters which are in your materials or their online account, so that you do not are in position of having them bother you later in the tax season. So there are going to be a lot of twists and turns. I don't think ENQ itself is the most material factor in this situation, but someday, as a result of an audit by TIGDEP, I might stand corrected on that. I just don't think they're a big enough company, Karen, with enough subscribers, even though they do robo-dial. It's really more on the intake side where the
large firms have used them. Yeah, and I got mixed reviews. One firm said that it is faster, and then another firm said it wasn't worth the money. So I don't know. I'm not paying it.
Yeah. And then Karen had a slide there on, Karen, did you want to tee this up? Because I will, the FAQs are very important these days.
Right. And, the reason I did that slide for practitioners from our standpoint is you should never rely on the IRS anyway. That's what people are paying us for. So if you're relying on an FAQ, double check it before you e-file the return, download it. Yes, IRS said that they're going to save them and they probably will. We don't know where yet, but download them and make that. But I wanted to make sure they realize the type of penalty. Oh, good. Tell us. They're
archived on the website. So that news release that Karen has up is in your materials.
Where is it on the website?
Yeah, but you have to go to the specific topic. So, for example, this week we put out about 70 or so FAQs on the child tax credit as it applies to the 2021 returns. It came out in a news release, and then we have the disclaimer there that this can be relied on for penalty protection. Again, Karen, if PICPA members and others go through and find the FAQ relevant. Now, I'm just sorting through those FAQs. In this case, on the child tax credit, we have another recent set on the recovery rebate credit. If you have a question on either of those refundable credits, my ask of any of the attendees today is do your homework first. Look at the FAQs, It takes some time. If you can't find an answer that impacts the preparation of the 2021 return, then I am open to you emailing me a succinct, clear email on your fact pattern, and I will find the answer probably in those FAQs. FAQs are a necessity because once the Tax Cuts and Jobs Act was passed in late 17, Chief Counsel realized we didn't have the bandwidth to go through the normal process to post formal guidance on the Internal Revenue Bulletin. So that's why we began using FAQs. The news release that Karen has up there, which again is in your material, it came out in October, describes counsel's position on these FAQs. So I would push back to say you can't rely on them. You can find them. You can search on, if you're looking for, we did this with the employee retention credit in a big way, as Karen knows. We have maybe close to 100 FAQs because that was a moving target as Congress passed 4 pieces of legislation, first creating the employee retention credit and then modifying it. But the FAQs are important, and they are your toolkit, Karen. They are the members' toolkit.
Yeah, no, I'm not saying don't use them. I'm saying just make sure that you document it, and there's only certain penalties, negligence or accuracy related that they will allow.
Okay, so let me. I'm watching the clock here for Justin. So some of this as we go. So I want to first in the updates. I want to look at the big picture here. So Karen, in the 64 questions she submitted to me, many of them revolve around themes that I've heard from tax pros over the past months. So we've gone into the tax season. It opened a week ago, I should say. What I'm seeing internally on some calls is that the 1040 platform is processing returns. I know many of you don't begin submitting e-file returns once we open the gate, but I have to warn you, cyber criminals who have stolen taxpayer data do start to attempt to submit fraudulent returns. I'm also on the Stakeholder Liaison, what we call our data breach cadre, and I track the statistics coming into SLs around the country. So in the month of January, we had 20 new data breaches reported to us by tax pros around the country. And usually that's because while they haven't met with the client yet, they're starting when they're getting rejects when they start to electronically file returns, or clients are starting to get correspondence from returns that have hit our filters asking whether it's that return. So and we'll get in later in the session, I think in the later in the morning, on some of the techniques that cyber criminals are using. But the big picture is you're operating now, as Karen said, and as we all know, in an environment where IRS is strained to the limit. So the advocate put out her report to Congress early in January. She has 2 reports she is required under the statute that you see on the slide to submit. One is an objectives report in June for what she and her staff are looking at. And then the report that came out in January or it was made public in January. It goes to Congress. It bypasses the IRS leadership. So I don't see that report until the news release comes out. So and in that annual report to Congress, which is several hundred pages, she reports the most serious problems experienced by taxpayers, the most litigated issues in tax court, the successes of her, I'll call them their boots on the ground advocates, both those who work systemic advocacy and those who work cases. And by the way, the caseworkers in the local taxpayer advocate offices, their inventory is out the window. It's 4 times what it is normally. And that's why case advocacy or the work of the case advocates, who are very dedicated, very knowledgeable about IRS systems, but they cannot resolve cases that come into their inventory. They have to work with the business unit that might have that case. And these days, I'm a bit reluctant to, even if I talk with a PICPA member and identify a case meeting the criteria for the advocate, I hesitate to advise you to submit a formal request to the advocate, given that inventory. But she also has legislative recommendations. She does have a bully pulpit to make recommendations to Congress about things to improve tax administration. And that's what they call the Purple Book in her report to Congress. So and I'm not here today to, to give you a sob story. We are all aware of what's happening, but this chart in her report really summarizes what has happened over the past 10 years and the situation we find ourselves in. When you look at the increase in tax filings and you look at the decrease both in IRS budget, and that includes the budget for service, for operation, for compliance, and also the budget for IT, that has gone down in real terms since it peaked about a decade ago. And corresponding to that, parallel to that, is the decrease in the IRS staffing. And their leadership is aware that in addition to the 20,000 or so employees we've lost over the past decade, we have thousands of employees who are eligible to retire from government service who have not yet retired. And that's an existential threat, frankly, to the IRS. So that's why now Congress is slowly waking up to that on both sides of the aisle, I would mention. And now, unfortunately, from the IRS budget perspective, the Build Back Better Act, which has stalled and probably will not move forward in the Senate unless it's unpacked, that Build Back Better budget had 10-year funding increases for the IRS to give us some certainty and continuity. So now, and we're coming up on February 18th when the continuing resolution to fund the government ends. So Congress over the next week and a half has to do one of two things. Either they have to ideally they would pass a budget for the entire fiscal year through September 30th. And that would give IRS some increased funding over last year to help start to work at some of these issues, including the hiring. But if they don't do that, then they will punt and they will pass another continuing resolution to fund all government agencies at the same level as this year. Now, so we're watching this daily within the IRS and within all the agencies. So in a report to Congress, these issues, not surprisingly, are the ones you've been dealing with. So on that mission critical page, which I think, Karen, you had up, we update that every Friday. So as of January 28th, we still have about 6 million 2020 returns, mostly paper, but some e-filed, still in processing. We have about 2 million 1040X returns. And as the advocate points out, and I agree with her on this, it has been very surprising to me that number of amended returns has not diminished in the past 6 months. I really don't know why. I can guess that it's because the examiners who are needed to review those amended returns, whether they're e-filed, 1040Xs, or paper filed, they are not doing that work or haven't been until now. So they have to clean that up. And on the payroll side, and this is one reason why Karen received questions on delays in processing the very important employee retention credit for your businesses, is that we have about 2 million or so 941s still in process, and then we have several 100,000 941Xs. And as is said on the mission critical page of irs.gov, and you have a link or the latest update in your materials, They cannot process 941 amended returns until the 941 for that quarter has been processed. So it has a snowball effect. Very unfortunate. But I know many folks, including Congress, are asking the commissioner to deploy resources to address that. I mentioned the recruitment and hiring. It's frankly, less of a problem, Karen, to get a trained CPA who wants to have a career, or at least for a number of years, where they get good benefits and learn a lot about to come in as a revenue agent or a tax attorney to come in to chief counsel. But it's much more challenging to get those entry level positions, right down to mail clerks, the lowest graded clerks. And that's what they're struggling with now. The fourth bullet there, and Karen, you touched on this, the mission critical page does not provide as much clarity as I would like to see. And we've had internal discussions about that. And the advocate has commented about the fact that the IRS on that page has to be more transparent, almost with a dashboard concept. We're familiar with dashboards where they give real-time updates. That would be the ideal, but we're not there yet. We talked about the filing season delays. Online accounts, I'll get into online accounts a little bit later. One of the strategic goals of the IRS, and it's going to take time, is to get many, many millions more taxpayers setting up secure online accounts where they can, over time, do a variety of things. Not only get transcripts, not only look at notices, but also if they want to voluntarily opt into the identity protection PIN program, to do that. If they want to set up an installment agreement online, they would have to do it through their online account. We only have a couple of million, I think, taxpayers who've set up online accounts, if that. But one of the goals here is to make one of the requirements, I should say, is that it has to be secure. So now, and you may have seen some stories on this. IRS, like many federal agencies and some state agencies, have partnered with a private sector trusted third-party provider. It's called, in our case, it's called ID.me. And ID.me now is authenticating when you register for an online account, or let's say you were new to e-services or new to setting up a Tax Pro account, you would authenticate using ID.me. What that means is you don't need a credit card in your name, or a mobile phone in your name, but you do need to authenticate using biometrics, using a government-issued ID and a selfie on a phone that you upload. So we have been moving forward with that. However, and I won't get too deeply into this issue, in the past week or so, as a result of some media reports, some of them I think were incorrect, there are concerns in Congress about privacy issues, about using ID.me. So the Treasury Department is looking at alternative authentication means. And Karen, I know you follow announcements, and I use you and others on the Federal Tax Committee. When decisions are made about other options for authenticating, if you're signing up for an online account, signing up for e-services or a Tax Pro account, I will share that with Karen and the members of the Federal Tax Committee. E-file barriers, not all returns can be e-filed. Part of this issue with the payroll returns is that over decades, relatively few 941s come in electronically. There are a variety of reasons for that, but that has to increase. Correspondence audits. So I do want to talk about, just briefly, a pause in IRS compliance notices, whether they're collection, balance due notices, intent to levy, correspondence exam. This issue now has percolated to the top of the commissioner's plate. There has been lobbying by the AICPA and other organizations to suggest that the IRS should stop issuing these notices, A, if a taxpayer has responded, or B, until we have the bandwidth at the service centers to process these incoming mail. So this week there's an ABA tax section meeting, and I just saw a brief headline indicating one of the attorneys from council said, we're considering pausing other notices. We issued, and Karen included it in your materials, we put out an announcement on Thursday of last week about IRS services, and we were issuing, some of you may have seen a CP80 notice. The CP80 notice indicates that there's a credit on the client taxpayer's account, but we have not yet, don't have a tax return. Well, in some cases, those CP80 notices, which are automated notices, go out about 6 months after the due date of the return, are because the taxpayer made the payment, let's say a BAL due payment, sent it to the lockbox, posted the account, but we have not yet processed the paper return. So I heard a lot of noise from practitioners on that. So on Thursday of last week, we put out an announcement. If you have a client who gets a CP80 and they mailed in the return and the check was cashed, my recommendation as of today is don't follow the instructions on that notice, which says send in a duplicate. Wait for the IRS to catch up with the mail. So, and some of these other notices, you may be hearing in the next couple of weeks about pausing. You know, when the pandemic hit in March, we did pause all notices for months into the fall. So the IRS sometimes has statutory requirements to send out notices, like the initial assessment notice when we process a return and there's a balance due. But those subsequent notices, like the CP501 balance due and the others, they are looking at whether we can administratively pause those, and maybe we should. So stay tuned for further details. Any comments on that, Karen?
Yeah, I'm just writing to Joel Silver, who had that exact question. He got that. I have gotten the CP80 notices too, knowing that the return was paper filed. I have one client that likes to do his own payroll returns paper filed. But my recommendation is, as long as the client, I just emailed him and said, hey, you don't want me to follow up on this, so you're covered. I just am telling you, watch out for yourself.
Right. So, yeah, thank you, Karen. So let me quick go through. I'm watching the clock here because we want to bring Matt and Jay up at 9:30. So I'm not going to get through all of these slides. In fact, but a couple of things. When we redesign the software, or when we redesign the forms and instructions and pubs in the software industry, we base it on recent tax law. Sometimes we make administrative changes. We may get into some later on the K2 and K3s. So the two big pieces of legislation were the December 2020 Consolidated Appropriations Act, and then, of course, which was a big challenge for IRS last March, was the Mid-Season American Rescue Plan. So I want to skip forward the slide deck. I want to get to a couple of things here. We will get into, and maybe we'll come back to this, Karen, after Jay and Matt.
Frank's
so the big three, who goes for? Oh, Frank goes first, right? So the big three, the big refundable credits are here. I do recognize that not all of you deal with the earned income credit, but more of you may this year because the earned income credit for children who, who are taxpayers who do not have children has been expanded. The recovery rebate credit, we're all aware of that. Child independent care credit, big changes there. This is 1 year where taking a look at the instructions, in this case, the instructions for the 2441 can be beneficial because clients who get the child and dependent care credit in the past may see a significantly increased refundable credit this year. And they're going to turn to you to explain it. So you want to make sure you can explain it to them. So I do recommend looking at the 2441, which has been expanded. I think it's multiple pages this year, along with the instructions. Child tax credit, I think we'll come back to that later. The big deal this year is get those 6419 letters. Most of them have gone out at this point. You're smiling there, Karen, but I do think I heard from an IRS employee.
Are they correct? We heard that they had incorrect notices, so hopefully the IRS is right that those correct ones are still.
So Karen, we put out an announcement on Thursday, the second announcement. Again, it's in your material up the front under the IRS updates saying we have a small number of and we don't know the exact number. We sent out about 46 million of these letters in batches. I think we were moving from lowest income to higher income recipients, but a small number might be incorrect if the December payment was returned to the IRS either because the taxpayer moved or they closed their bank account. So overall, most 6419 letters are accurate, but you might have to have the client look at their online account or get a transcript for 2021 to cross-check. But I don't think it's as big a deal as the noise in the tax press and in the general press what led one to believe a couple of weeks ago. And this is why when subsequent announcements come out, I know Karen looks at those quickly, but I will make sure she sees it if it doesn't. Earned income tax credit. Some of your clients get the marketplace coverage. The premium tax credit has, as a result of ARPA, has some beneficial changes so that they don't have to pay back in many cases. I want to skip over. You have that 8812 schedule is the schedule for the child tax credit. Your software will calculate it, but that form, which has been around for years, dramatically redesigned as a result of the American Rescue Plan. I would suggest downloading the form and the instructions. If you have any questions on those calculations, you can reach out to me. Software has reprogrammed that. And then the line items on the 1040 and the schedules, I'll presume you've looked at those changes. The one minor note here, if you have non-itemizers, the deduction for qualified contributions to charity has been moved to a below-the-line deduction. It's below the line for standard or itemized deduction. It's $600 for couples, $300 for all filers. So, Karen, we're right at 9:30. I think we should, out of courtesy, I'll scroll through to the slides for the SALT trends. Is that okay?
Oh, yeah.
Karen? Okay.
Yeah, yes.
And you want to tee up, I'm not sure who you're going to tee up first.
Yeah, because the second half of yours will do all, it'll be you talking.
We'll get into these issues. And I'll have a chance while the second portion, take a look at the questions coming in.
Yeah, that's why we redesigned the course, everybody, so that Rich would have a chance to look at the questions. So he has a break while the SALT team is on.
Okay. So now, Karen, who's going to move these slides? Will it be Jay
Frank,
or?
Are you going to move your slide?
We'll have somebody move the slides. Thank you. All right. Shruti, are you going to move those slides, please? All right. I go right in, Karen?
Say go, Frank.
We'll get to that first slide. Good morning, everyone. And thank you to the PICPA and Karen for having me here today. And thanks for all the work, Karen, putting into this. I know it's a lot of work goes into a presentation like this, especially with so much last minute information coming up. Great stuff, Rich. And, I can certainly empathize with the challenges that the IRS is having in response to the pandemic, and all taxing authorities are really, pivoting and faced with challenges. But I'm here today to give you some updates, and I'm really pleased to be here in this part of the SALT discussion with Matt and Jay. So I know we have time constraints, so I'm going to move rather quickly. My goal here is to bring up as much to get to you as much information as I can in a short period of time that gets you some assistance and points you in the right direction and makes tax season easier for you. I know it's going to be a very challenging and difficult tax season for everyone, and my hope is that I can give you some tips and some contacts that will make that easier for you. So let's jump right into the agenda. And what I plan to cover today is information about the Philly Tax Center, some wage tax information, refunds. I know refunds are on everyone's list of things, wage tax refunds. So and let me jump right in. My system's playing a little havoc with me here today, so I apologize for that. What slide are we on? All right, could you move to the next slide, Shruti, please? All right. So let me jump right in here with the Philly Tax Center. You probably had some experience with the Philly Tax Center. The Philly Tax Center is live. We went live with that on November 1st, and one of the challenges that we'll have this year is we'll be dealing with two systems as we navigate through this year, because our implementation is a two-part implementation with many of the taxes going in phase one. Sorry, Shruti, I know I'm jumping around a little bit. Going in phase one, and then the balance of the taxes going in phase two. So you can see right here the taxes that went in phase one. The most relevant, the business income and receipts tax, and the net profits and wage tax, also the school income tax this go around. And in October, we'll be looking at putting the property-based taxes in, the real estate tax, the UNO tax, the realty transfer tax. And I think the real estate and UNO will be the biggest impact, maybe the UNO from practitioners, but certainly from taxpayers' perspective, the real estate will be a big one. One point I want to bring out right now is certainly go into the Philly tax system and the Philly Tax Center and register. That registration process is a little different in that you can't register in a one-stop visit. You need to go in, start the registration process, then a letter needs to go out that gives essentially a PIN number so you can come back in and finish the registration process. We realize that is maybe not the most efficient process, but it certainly for us was the most secure. In our database, we did not have the most up-to-date email addresses and mobile phone numbers. So using that kind of dual authentication where we use those as a source was not really an option for us. And so we realized that this lag in waiting for that letter to come is a little bit of a challenge. Now, what we're finding is some taxpayers and tax professionals are not receiving that letter after they do the first part of the registration process. And we're finding to a large degree that's because the address had never been updated in our system. So there may have been a change of address that your client had, but never was updated with Philly Department of Revenue. So before you do the registration process, please check to see if the address is correct. If it is not, have that address corrected before you start the process so that the letter goes to the right address. If you have gone through the process and you haven't received the letter, call our taxpayer service line. You probably all know the number, but it's 686-6600, and call them. They can walk you through the process. They can either get a new letter out to you, they can update that address, and in some situations, they can immediately give you a PIN number. So we're trying to resolve that issue for all of you, and we realize that's been an issue, but our utmost concern was security, and this was the most secure way to do this process. So thanks for that. There's a lot more information out there about the Philly Tax Center, so please, I have a resource for you here. Take a look at that. We've got videos out there. We've got informations of how to do different actions. We also have a dedicated newsletter that you can subscribe to. So I recommend doing all of the above. I know, time is tight right now, and but this is, time probably well utilized to the degree. If you're having a problem with any particular thing in the Philly Tax Center, kind of take a look and see if we have a resource to walk you through that. And also definitely do the dedicated newsletter. That only takes, a minute, and then you'll be getting up-to-date information throughout tax season that could be really helpful as things change. This is a new system, and what you're seeing right now isn't the end result. It's evolving, and things are going to change and improve, and we want to make sure that you're aware of those improvements. Let's jump now and talk a little bit about wage tax refunds. I know that is a big issue for everyone. Last year we did probably, the numbers constantly changing, but getting close to 40,000 refunds in compared to, 6,000 to 8,000 refunds in other years. And of course, that's all because of the shift to remote work. And now lots of non-residents are working remotely from their homes and are able to, or do not have to pay the wage tax during that. So next slide, please, Shruti. Just a reminder of our policy, a non-resident who works from home for the sake of convenience is not exempt from the wage tax. So the employee has to be required to work remotely. And we have great FAQs out on the system. There's so many variations on this theme that I really don't have time to get into them during this presentation, but we have great FAQs that cover hopefully many of the situations. We're also getting questions coming into our technical staff. So you can contact our technical staff if you have those questions. And we're starting to see some requests for legal opinions come in too. So some employers, this is a big issue, and they want to make sure they're doing it right. So they're actually asking, requesting a formal opinion, and we have a process for that too. I think most of the situations that will get addressed in the FAQs. Always remember that two things I'll point out about the refunds. They are in the Philly tax system now, and we think that's going to make it a much better, more efficient process. Last year we had some delays because we had some challenges with the technology we were utilizing, and I'm proud that the department pivoted really quickly and did a yeoman's job of getting those refunds out. But admittingly, there were delays and some challenges in that process because it was something volume we had never seen before. And within the Philly Tax Center, last year we did the ability for employers to be able to file on behalf of their employees, and that will be up and running within the Philly Tax Center. It is not there yet. The intent is for W-2s to get submitted with that spreadsheet or with that form, but that is not live yet. That is still in development. We're hoping to have that out soon. It was a pretty significant lift within our systems. So one of the things that came up as a question many times, and I just want to cover real quickly, is bonuses and awards, vacation, leave time. That all kind of gets treated based on the same percentage as the amount of time that the employee was outside of required and to work outside of the city for the period of time, if we look at the bonus, for the period of time of the bonus. And there's an example here that you can use as a reference. I realize that it oversimplifies to a degree because it only talks about the bonus period being that is paid in the subsequent year, but you have the whole year's worth of wage tax to deal with. But the point here is to help you understand how the bonus should be treated. And what we're trying to do is, you noticed last year we made a new form, which we called the COVID EZ form. It was the first time we had a simplified form for the wage tax filing, for the refund filing. So that will be around again this year. That was well utilized, and I think made the process easier for you and also for us. But remember that does not apply for cannot be used for those situations where employees have things like stock options and travel and business expenses. So there's situations where you really need to make the decision for your client whether you should be using the COVID EZ form or whether you should be using the standard form. And for the employer form, that's basically designed for the situation of employees that are required to work at home. So it's really for remote work. It's essentially a group filing or a bulk filing for all of those employees. It doesn't really address the other situations that I just talked about, which is, travel, stock options, business expenses. They need to go on the standard form. And we did a pretty good job. Not we weren't perfect, but we did a pretty good job of turning those around, I believe, relatively quickly. And I think that we'll do a much better job this year now that we have a better idea of what resources are required. We have kind of an idea of what the cycle of those and volume of those coming in are, and we look forward to this season going a little bit smoother than last year. Next slide, and I'm going to skip by this slide because I think I already covered that. Go ahead, Shruti, to the next slide. Okay, something new this year that we have are offers in compromise. They kind of always existed, but we really reformed this and revised this process. And so I'm not going to spend a lot of time on it just because I know that's something that maybe isn't a big issue right now during tax season. That's not where your focus is, but I wanted to make everyone aware that we do. Go to the next slide, please, Shruti. That we do have this. It's certainly for extraordinary cases where the taxpayer is unable and can demonstrate that they're unable to pay the total liability. Of course, it's situations like medical expenses, might be more prevalent now as, our people are faced with, a multitude of challenges, from, whether they be from COVID, health issues and medical bills, whether it be people that are faced with, passing of a business owner. We have hurricane situation with Hurricane Ida and just businesses closing or challenged because of the economic environment. So this is another tool we wanted to add to assist taxpayers. Our focus throughout this COVID, throughout the pandemic and the other crises that have happened over the last 2 years is really being focused on helping businesses recover. So recovery has really been the tool. We've added a lot. I'm not going to cover it today, but we've changed our payment agreement terms. We now have terms that could be as much as short. We have a short-term kind of recovery payment agreement where taxpayers can get in that, and it's a 1-year program and pay no interest and penalty. But everything has been kind of revised with a look at recovery, and we did pause all compliance for a period of time. We're gradually resuming that, but we're not to a full compliance state yet. But again, our focus remains on recovery, and offers in compromise. It's just another tool to put in the kit to help businesses recover. Next slide. All right, here's the information. It'll be in your resource package of how to go by, how to do an offer and compromise, and there's information on our website. So, utilize this where appropriate, and if you have any questions, you can certainly reach out to us, and we'll be happy to answer it. There's an email address there that you can utilize for offers and compromise. Not only would you use that for any questions, and that goes directly to the unit that handles those, so we'll be able to get back to you quickly. All right, next slide. Obviously, we do not guarantee acceptance into the offer and compromise program when someone applies. But what we'll do is, we'll certainly review that application. If it qualifies, we'll walk you through the process. And if it does not, we'll present other options. As I just said, we have lots of options to bring taxpayers into compliance. So we'll be happy to work with you to do that. Next slide, please. Our temporary nexus policy during the pandemic has ended. It ended June 30th, 2021. We could talk for some time about this. Again, we don't have the time to really dive into it, but I wanted to make sure everyone was aware. This is really critical as you start getting into doing tax returns for businesses this year. And if after June 30th, they still had a presence, that business had a presence within Philadelphia that was a result of people working remotely and was a result of the pandemic. And if that persisted beyond June 30th, then they would have nexus in Philadelphia and be subject to Philadelphia taxes. I believe that this time period and this nexus policy is consistent with the state, and something that certainly Matt and Jay may dive into during their presentation, and I'll be on board for that presentation as well if there's any Philadelphia questions that relate. Next slide, please. The city has prevailed on the Zilka case. For those that aren't familiar, the Zilka case is our local version kind of the Wynn case. It is a challenge where a taxpayer is attempting to take a deduction or a credit for taxes paid to another jurisdiction against the Philadelphia wage tax. And while we do allow taxes to other cities to be deducted as a credit against the Philadelphia tax, we don't allow taxes that are paid to the state or other, I'll call them non-like jurisdictions, to be taken against the Philadelphia wage tax. This was a Commonwealth Court case, and it's extremely well written, so I can't do it justice talking about it, and I really leave that to the attorneys, but I wanted to make everyone aware of this case. It may be appealed to the PA Supreme Court. I don't believe that has happened yet, but wouldn't be surprised if that happens. And so it's still a case to keep an eye on. But Philadelphia, we have prevailed at the Tax Review Board, Common Pleas, and at the Commonwealth Court on that case. So just keep an eye on that one. And just wanted to also make you aware that there is a tax reform group that's been meeting and working, something that the mayor announced, I think, back in June, and they've met. There's 19 committee members. We have members from city council, from the administration, from the business community. Some of you out there in the audience may have participated or may have participated as part of outreach. The goal is the creation of an action plan that supports equitable, inclusive economic recovery for Philadelphia. This is a little bit different than other tax reform committees have worked. This has been on a very aggressive timeline. It's trying to really narrow down some reform items and reform suggestions that can be implemented into the 23 budget. So really actionable rather than a holistic kind of long-term set of recommendations that may or may not be actionable. So the group was tasked with developing reforms that spur growth in employment and new business. And basically, my advice here is just stay tuned. This is really closely tied to the budget process. So between now and spring, you'll be hearing what the recommendations, there'll be lots of opportunities for feedback, and then it'll become part of the budget process, and we'll see how that moves along through the budget process. So I think I have pretty much used up my time. I don't know if we have time for questions. If certainly any questions that we don't get to, we'll try to get answers back to. And I'll defer to Karen on how we want to move forward here.
Or Matt, either one, Matt or Jay.
I'm here. Can you hear me, Karen? I'm here. All right. Let's see if they can give me control here. All right. Good morning, everybody. My name is Jay Brower. I'm a managing director with CBiz, Marks Paneth. And by the way, thank you, Frank, for coming on. I'm sorry that there's a little bit of a delay here in the video, so I was a bit confused there. But Frank, thank you and your folks for putting together your presentation today. And everyone has the slides, so we can go back and review those to get some good information on what's happening with the city taxes. I've been on the website. It's very helpful. Finding ways to file returns through it and everything else. So it's good to see that the city is keeping up with the tech on that. So I will introduce myself again. My name is Jay Brower. I'm with CBiz, Marks Paneth in the Philadelphia office. Joined today by Allinson, who probably doesn't need much of an introduction, but Matt, go ahead and introduce yourself.
Hello, everyone. Thanks for taking time. Thanks for the opportunity to present. And Frank, thank you for coming on. We're very blessed to have the Revenue Commissioner himself join us and give you guys a kind of a firsthand account of what's going on with the city. We'll make some comments on city taxes as well as multi-state taxation. Also, amazing. Karen's amazing what she does to set this whole thing up and puts a lot of hard work into it, as you can probably tell. And getting people like Richard on and Frank and Jay and I are certainly honored to be able to present together and with that group. I'll just say to lead back into Jay here a little bit is, it's funny. I've been doing state and local taxes. The years are flying here. Now it's getting to be a long time. And it was always a great area. It was always like cool developments coming out. I like it. I always enjoyed it because it was intellectually challenging and it requires some creativity and some, you got to learn how to live, like I call it in the gray a little bit. Like it's not always crystal clear what the answer is. And it's one of the things I like about tax in general and specifically the state and local tax. But I feel like in recent years, like we're going to talk about, some of the post-Wayfair stuff as part of this. But like in 18, I saw, man, this is one of the landmark events in the history of SALT. And really it was. But, lo and behold, a few years later, we've had topics just as hot as that, if not arguably hotter for some, with remote workforce and COVID and all the relief that relates there too, and the business activity tax. So we'll try to cover as much as we can, Jay and I, from kind of a multi-state perspective, but with obviously a concentration in the local market here within Pennsylvania and the surrounding areas. But it's just really it seems like it never stops. And it's awesome, Jay, all the stuff we get to deal with and try to figure out. And with that, let's get into our slides, Jay.
These states, not just one administrator. So, anyway, here's our agenda for today. This is again broken up into two sessions. I don't know that we're going to get to all these topics based on the time constraints, but we'll do what we can. We may move around a little bit, so we may not follow the slide deck as it's currently organized here, we may put something off to the second session if we can't get to it in the next 20 minutes or so. But to start with here, we'll talk about the Pennsylvania budget for 2022, passed back in June. It was on time. Really not much to talk about here other than if you have an individual client, individual taxpayers, if they have to make a Pennsylvania PIT payment of $15,000 or more, that payment has to be made electronic. They could write a check. They're going to get dinged with a penalty. That penalty is up to $500 for paying the tax with a check. So, fortunately, this doesn't affect many taxpayers, but if you're someone with income of $500,000 or so, paying an estimate of $15,000 or more, or a balance due with a return of $15,000 or more, that payment really should be made electronically. You can do that through the Department of Revenue's website. We have a link to that here. That's also a good website to go to check on your client's estimates. You can still call 1-888-PA-TAXES and get estimated tax information by going through the phone menu. But you can also go to the MyPath website and obtain information on your client's estimates if you're not sure what they paid and when they paid them. A couple other things for sales tax, really minor, doesn't affect a whole lot of people, and some credit things that they've enhanced, but we won't get into all that stuff. We just don't have time to discuss everything in the Budget Act. A few court cases here we wanted to make mention of. The O'Donnell case was issued back in late December. Really limited application. Essentially what it says, if you receive a whistleblower award, this happened to be a federal, what they call key TAM case, a federal whistleblower award, that is compensation for local earned income tax purposes and presumably also PIT purposes at the state level. That was a Supreme Court case. So that's sort of the final arbiter on this issue. Briefs have been filed for the court to reconsider its decision. Whether it does or not, we'll see. But as of now, if you have clients that get a whistleblower award, they're supposed to treat that as compensation income. The next case is Pearlstein, which again came out in early December. This was a Commonwealth Court case, and this case deals with Section 1031 exchanges. As I think most of us know, Pennsylvania Department of Revenue takes the position that for PIT purposes, there is no such thing as Section 1031, at least deferral of gain. If you exchange real estate for real estate, you have a gain, a deferred gain from that at the federal level. Pennsylvania says you got to pay tax on that if you're either a Pennsylvania resident or the property is in Pennsylvania. Here the taxpayers argued, look, we follow the federal income tax method of accounting. That's a validly accepted method of accounting. And under that method, you can defer gains. And the Department of Revenue's position was, well, it's not that method doesn't clearly reflect income when dealing with a Section 1031 exchange. And the Commonwealth Court here found in favor of the Commonwealth or the Department of Revenue on this issue. Taxpayer plans to appeal that to the Supreme Court. Whether or not the court decides to take the case, we'll see later this year. Matt, I don't know if you have a comment about Pearlstein there before we move on here.
No, nothing. I'll hold off until Good Shepherd, Jay.
Okay. Next is Good Shepherd. This is a local business privilege tax case. The city of Allentown was getting very aggressive in enforcing their business privilege tax. They went after an organization called Good Shepherd Rehabilitation Network, which is a charity that operates several different things up in the city of Allentown. But Allentown tried to impose a business privilege tax on at least a portion of their receipts. They assessed a tax against the organization. The organization went up through the appeals chain, got to Commonwealth Court. And Commonwealth Court, I think, looked at the business privilege tax ordinance which clearly exempts nonprofit corporations or associations operating as a purely public charity. This organization is a purely public charity. So the court's like, hey, your ordinance says it right here, guys. Why are you trying to tax this organization? So the assessment got thrown out at Commonwealth Court. I don't know if the city's going to appeal. Matt, any comment on the Good Shepherd case? I think you did want to make some comments.
Yeah, a couple comments on the case and even the broader maybe repercussions. For those that may work in not-for-profit or serve not-for-profit clients, I mean, this is kind of big deal stuff to keep your eye on. I mean, it's been out there for a while. Those of you would be familiar with things like the HUP test and Act 55 and the case law that's come out over the years. And here's another example, and it went in the taxpayer's favor here. But I always, when I talk to my not-for-profit clients, I analogize it to like buying insurance sometimes. And I feel like sometimes none of us want to face up to the reality of buying, say, life insurance or some other kind of insurance. You got to look at your not-for-profit exemption. These tests, these all or nothing tests tend to scare me. Like, what if the taxpayer lost here, or in a case like this, it's like, okay, what does that mean exactly? Does that mean I lose, like, what's the corollary there? Does that mean I lose my property tax exemption? Does that mean I lose my sales tax on purchases exemption? Like, you got to be cognizant of the whole picture sometimes, even though it's like maybe a narrow case about a specific tax type. What are the bigger picture ramifications? So, I always like kind of trying to encourage these companies to drill in a little bit and make sure they understand how secure are you. Good Shepherd by nature is, I don't think anybody's exactly challenging a 501c3 status there. If you get my drift, Jay, at the federal level, I don't mean to downplay it or anything, but like it's pretty safe there probably. But a lot of these organizations are a little closer calls. And, could be at risk when you start drilling into the Pennsylvania specific rules. So I just say keep your radar up. And then the secondary topic there is Allentown in general. Allentown's definitely there's some people who are like thought leaders at the local BPT level. And, they're definitely among them, some of the folks in Allentown. And they're getting, as Jay put it, fairly aggressive, or like they're even leveraging off like kind of Wayfair type concepts and looking at concepts like bright line tests based upon, amount of sales and number of transactions in a jurisdiction. This is not unique to not-for-profits, but just, certainly keep your radar up. We'll get later in the presentation to stuff about remote workforces, but it's definitely a hot time for local BPT type activities from a lot of different angles. One to keep your radar up on is the sort of transactions test and sales test that Allentown's probing the waters with here.
Yeah, Matt, you mentioned the federal 501c3 versus Pennsylvania tax exempt. I mean, they are different things. Pennsylvania is much more stringent as to what actually qualifies as a charity. And if you don't meet all those rules in the you could lose your exemption for all taxes, property tax, sales tax, income tax, everything. So, and in this case, could have gone the other way, right? And if the court looked at the activities and said, well, you don't give enough of your services away for free, you don't meet this one element of the HUP test, then they could have been held liable. And, other cities might have picked up on that and said, let's start looking at other organizations here in Scranton or Pittsburgh or Allentown or Easton, whatever, pick a town with a BPT. This could have, if it went the other way, it could have been bad news for a lot of nonprofits. All right, next case, Zilka, Frank mentioned that, so we'll skip over that here. Also want to make mention, now this has been around for a few years now, just want to put it back out there. I don't think Frank mentioned it in his session, but Philadelphia did adopt an economic nexus threshold for the BERT, not NPT. This is for BERT only. If you're outside, if you're a business outside of Philadelphia, you've got no physical presence there, but $100,000 or more in receipts from Philadelphia sources, you are now subject to the BERT tax, at least the gross receipts tax portion of it. PL 86272 still applies. if all you're doing is soliciting the sale of goods that are being delivered from outside of the city to orders accepted outside the city. So 86-272 is still there, but the city is looking to go after companies outside of the city that are at least selling goods into the city. I added the last bullet point here because Philadelphia is, for service transactions, Philadelphia is still a cost of performance jurisdiction. So you source the revenue for services based on where you actually perform them. But there's to that rule that deals with what they call software companies. And you say software company, that kind of puts in your mind, okay, I sort of know what a software company is. That's Microsoft, that's Oracle. But the definition is a little bit more expansive, and this could affect even some smaller businesses. If you're doing computer systems design, internet publishing, a web service provider, data processing and hosting, that is a software company under the Philadelphia term. And if you are providing services to a Philadelphia-based business, and you are a software company, if your revenues are more than $100,000, you could find yourself perhaps being subject to the BERT. Anything you want to mention on that, Matt, before we move through here?
Yeah, Jay, a couple brief comments on that. Let me go back off your last point. I do have clients in that situation, and you get to some if you got non-residents of Philadelphia, you can get to some undesirable results if you get my drift. That may seem unfair, but life's not always fair type thing. But you got to at least be aware of it and then know how to know how to play defense in that situation, or know how to kind of handle it. But it does feel a little tough that it's just geared at one industry there. And like Jay points out, you got to be cognizant specifically of the software company reach there. In general, Frank mentioned that Tax Reform Commission. I am one of the members of that Tax Reform Commission. I think there's like Frank said, 19 people or something like that right now. But one of the pretty interesting things I learned in that is that when they went to this $100,000 exclusion and they said you don't have to file anymore unless you hit it, the number of filers went down. I might blow the numbers here, but I'm pretty sure it's something like this. It went down from like 130 something thousand filers to like 35,000. It went way, way, way down, the number of filers. Mm-hmm. Really caught my attention. I thought they did something better than I realized, I guess, for small businesses. I guess I just didn't realize how much of an impact that would have in all candor. Now, again, for some of it, people, sophisticated audience like, PICPA on the line, you got to make some decisions sometimes on that. And this has come up a lot. Should you file just to run a statute, just to protect yourself in case there's any doubt about the level of receipts and things like that? Yeah, obviously got to analyze that case by case. If there's any doubt, my lean would be to just go ahead and file.
Yeah, there is a form for that, Matt.
There's no doubt.
Sorry, the delay's hitting me here. There is a form for that. It's called a no tax due. So it's like a one-page return. You check off a box. It says I had less than $100,000 of receipts. You file that electronically through the department's website, and you've sort of told them, I don't have to file a return, and here's why. So hopefully that presumably that should statute running. But you may want to file that form if you do have a BERT account. Otherwise, if you don't file it, you get those notices that you didn't file, and if you ignore them, you wind up with being sued in court, and you have a code enforcement complaint, all that other good stuff to deal with. All right, moving along here. Okay, Frank talked about requirement of employment standard on wage tax, so we can skip over that. Let's get into our next topic here, nationwide.
Jay,
go ahead.
If you don't mind, that one's just such a biggie. I wouldn't mind, and I know we're going to get to it in more in the remote section, but just on Philly, given the audience here, if you don't mind, I'll make a couple comments on this one here. While it's been out there a while, the devil's in the details. It's okay to say, okay, requirement of employee versus employee convenience. Those are words, but then how do you put this into action in this weird kind of nebulous time that we're in, where people in certain industries, frankly, like ours being one of them, may not kind of have to go into the office, but like, this is like a great time to take a step back, to be where tax consultants can be true business consultants here as well and have a seat at the table in, a major business decision that's being made by companies of what are we going to do about our employees? You read about the Great Resignation and things like that. And there's some validity to that for sure. So you're trying to offer your employees flexibility, but by offering them flexibility, you might get to a bad tax answer here, Jay. When you start throwing words around like flexibility and you can do whatever you want. Okay, when you start saying that, Mr. President and these guys come in and say, oh, wait a second, that ties to our rule. That's for the convenience of employer, right? So there's a lot of devils in the detail type stuff in terms of how you might want to word this and how you want to document it and your policy, the communications and what you state to your employees, even employment contracts. And I know the city has been very generous in offering their time and resources in terms of being able to look at specific fact patterns and try to, help you make a determination as to what the rules should be here. But I mean, I'm getting loads and loads and loads of consultations on Philly specifically, but also on, around the Commonwealth of Pennsylvania. And Jay, we'll get into multi-state later, but it's a really interesting issue, and it's not a hard, it's like back to the opening comments, Jay. This stuff it's not like black or white, here's your answer usually. It's sort of like, well, okay, what if the guy comes in 3 days a week? Okay, what if the woman comes in 2 days a week? It's less than 50% of the time. But what about the person who comes in 3 days a year or might come in once a month or something? Are they all different fact patterns? Or do you take a true literalist approach and say, well, they could have come in. What if the office space only is going to be ample because we reduced office space and it can only fit 100 people, but we have 300 employees? You tell me that the city should get the tax on all 300. I could go on a long one on this one, Jay. I won't do it, but I'm just trying to highlight for the audience. There's not always as simple as it may seem, and there might be some opportunity for creativity and for you to add value to your company or clients here.
Okay. Thank you, Matt. So that next topic to discuss here is remote work. Obviously, it's been almost 2 years, right? Everybody was going to go home for 2 weeks, shelter. Wait for this thing to kind of blow over. Spread out the whatever, whatever the term was, I forget now. It's been so long. So a lot of people went to remote work. A lot of people said, I'm getting out of the city. I'm going to go to my shore house in New Jersey or some other state. I went up to the mountains in another state. I'll work from there. And a lot of states said, you know what, we're just we'll look the other way. If you went to New Jersey, we went to your shore house in Wildwood, Cape May. New Jersey said that, we're not going to really pay attention to the fact that your employer is now employing you here. You're working here. That won't give rise to nexus. But we're into this 2 years now. And this past summer, most states that had those sort of look the other way rules or not, I don't see it. Those rules have now been repealed. Pennsylvania did it as of July 1st. New Jersey did it, I think, in September of last year. So now if your employees have stayed in the state, they're still working there, you likely have some form of nexus in that state. You've got physical presence there. And that brings into account questions on, withholding tax. Is there a corporate minimum tax at least? I mean, you don't have revenue there perhaps, but what if you've got employment there, you've got nexus. So are you required to file a corporate tax return or a partnership return? Unemployment. Think about unemployment. Where the first thing you look at in unemployment is where are the services localized to. So you may have to unemployment in the state where the employee is working from of the time now. The other thing to consider here, we've seen this in the accounting industry for sure. This great resignation. Employees are saying, "Hey, I'm not coming to an office anymore. I like working from home. You make me come into the office 3 days a week, 2 days a week, 5 days a week. Guess what? I quit. I'm going to go work for a that doesn't make me come in at all. So, employers are sort of left with, hey, look, we want to keep a workforce. Some firms are enticing employees to them by saying, work from home 100% of the time. You'll never have to come into the office. But obviously, this gives rise to potential. Well, certainly it gives rise. It's not just potential. It gives rise to nexus issues throughout the country here. So I mentioned, income tax withholding. I mentioned unemployment, even workers' compensation. Some states have their own workers' comp laws. Maybe you that. I'm not a workers' comp guy by any means, but it just occurred to me when putting these slides together. Hey, that could be a potential issue too. All this stuff to consider. Getting into withholding tax. Some states, New York, which I deal with a lot, they've got this convenience of the employer rule. If you're working for a New York-based company, New York says, hey, your wages are sourced to New York. We don't care that you're sitting in your home in Delaware County, Pennsylvania. Even if you couldn't legally travel to New York during the pandemic, the early months of it, we don't care. That's no excuse. You still have to source your wages to New York. That's how tough they are on this. So New York is probably the toughest state on this convenience of the employer rule. A few other states have them. Pennsylvania is one. They don't tend to enforce it so much that I see. Matt, any commentary here? I'm sure you have some thoughts to give.
Yeah, I mean, plenty. I guess I led in with some of the comments with Philadelphia. I mean, I agree with Jay's analysis. Like New York, in my ranking of areas to focus here, New York State would be number one. There's a lot of history there. There's a case called Zelinsky that you ought to read. There's a slew of other cases in New York, Huckabee, Anito, etc. That's really the thought leader or the case leader on the subject. Philadelphia would be a distant number two in terms of kind of enforceability over the years and things like that. And then there's 4 or 5 other states, including Pennsylvania. They're the ones around us, by the way, for the most part. It's like Delaware, Jersey. I might blow. There's like an oddball like Nebraska or somebody's in the mix there. But these, it's a really, really cool and hot topic. I would almost guarantee it'll be litigation. We'll talk about, maybe the New Hampshire, Massachusetts case. There will be litigation on this topic, but we're in the trenches sometimes. We can't wait for 5 or 7 years for litigation to unfold. We got to make decisions now in anticipation of what can occur, what may occur. Like I said, I think it's just a matter of really getting into the guts of the business, doing your best to document things in a favorable manner. Or if it can't be documented, if clear answer is it's going to be, employees can do what they want, well, then let's start breaking it down from there and then work with people, the authorities like the city of Philadelphia or New York State, or just eat the tax cost. Maybe it is what it is. It just may be, we concede the tax there.
Yep. So and we're about out of time here in our first session. So just the final slide here to wrap this discussion up. Look, employers need to know where their people are. You got to write it down, document it, document what your policy and your system is. You've got employees working all over the country. Well, hey, guess what? You better be aware of the laws in the states where they're working from. I'm dealing with a client now that they're based in New York. They've got employees all over the country. Those employees don't want to pay New York taxes. So we have to find ways to get them, what they call a bona fide home office. It's not easy to do. Or they have a policy where that employee is not permitted to come to New York to work. If that's the case, there's a case that says convenience of the employer rule doesn't apply. But if they do go to New York for a couple of days for a meeting, something like that, you can't use that case anymore. So you've really got to look at your workforce, see where your people are, set your policies. It's today in today's environment, especially with a service-based business, giving the employees the freedom to work from home, wherever that home is, that can be something that entices employees to come work for you if you give them that freedom. If you tell them they have to come to the office 2 days a week, 3 days a week, 5 days a week, that's going to turn a lot of people off. They're going to say, nah, I'm not going to apply for a job there. Or I'm not going to take the job there because, frankly, I like sitting here in my pajamas on my couch and working, right? So, Matt, any final thoughts before we take our break?
Yeah, just a couple final thoughts. The late great Vito Cosmo used to say, usually the tax tail doesn't wag the business dog, Jay. But this is like I alluded to earlier. This is where you got to become a true business consultant in the consultations and understand the bigger picture of what your company's trying to accomplish and things like that, and kind of weave tax implications into that. We didn't hit it too hard here, but there's major apportionment implications embedded into this as well. Jay kind of alluded to that, but your business taxes and how you're going to handle that. These same concepts that apply. We're kind of focusing a little bit heavily on the employment tax, and these questions tend to stem out of that. But there's business tax apportionment implications as well in terms of where your people are, where your property is to some extent, and Jay, for service-based businesses, where your revenues are, then in turn. So great topic, and this one's not going away anytime soon, Jay.
Nope. No, it gets more interesting as we keep going along. All right. So we've reached our break time. We're going to break for 10 minutes or so. Then we'll come back with Rich Furlong. And when Rich is done, Matt and I will come back. We'll start talking about state pass-through entity taxes and everything that's going on there and several other issues to fill out the rest of the day. Thank you.
Today's program was planned by PICPA's Q&A with the IRS Event Subcommittee. Learn why your peers get involved with this initiative. What are the benefits of being a committee member?
Well, there's extraordinary benefits from being on committees.
I'd say first and foremost is having that frontline connection to Rich Furlong.
The benefits of being a committee member are really access to the wealth of knowledge that's out there in our region for tax.
You get so many different perspectives. You get to interact with other members who have a different type of clientele or a different stage in their development.
I think it really helps us all be better professionals and do a better job at what we do.
What kind of work does being on the committee entail?
On this particular committee, there's a lot of options to contribute in any way that is comfortable or fits into your schedule.
Really, the work that's involved is really how much you want to put into the organization and the committee.
Participating in this committee, I have built relationships and connections with different people and can reach out on different areas of expertise.
I have a lot of respect for the people involved in this committee because there's so much behind the scenes that people aren't aware of.
Do you feel there are any benefits for your firm?
There's a number of benefits that I've seen over the years. I've been involved in this committee for 5+ years. And one of the things that I always take away from this is every year I'm learning something new from the committee members as well as the volunteers.
We're all trying to do things to help our tax clients. And I think just the connections I'm making by being on this committee are huge.
When I teach professional education in other states, I always encourage CPAs to get involved in the technical committees because they're going to meet people that is going to expand their capabilities and their access to resources for their practices in those particular states. So yeah, it's helped my firm a lot.
Okay, I want to go through these because some very thoughtful questions. First of all, I don't know if Mary Malazita is attending today.
Yeah, she did the slide deck in the back, and I just have the slides there so that if we need time, we don't have Q&As. But Q&As are most important, especially your recommendation, like Andrew about the method to fight the IRS, or Howard about not getting an IP pin, or those things in the chat.
Yeah, I'm going to go through all of them. But first, Mary, if you're listening, at the break when I was watching the videos of you, Jim, Carlo, I did a spit take when you said that the best reason to join is access to Rich Furlong. So I'm not sure that's the best reason to join, but I got to tell you, for any attending today, the volunteers, Karen, Carlo, Jim, Mary, Jay Brower, Matt, they all do wonderful work. So, I'm not a member of the PICPA, but they're always looking for volunteers, I think. Is that correct? So I want to go into a couple
Yes, especially
I want to go
with
back.
background.
Yeah, I want to go to the top here. Oh, Mary's here. Okay. So I'm still playing with this here. So Andrew asked, with the ongoing issue of the IRS with regard to customer service noncompliance, recommend not to submit abatement letters through the mail. So, Andrew, important question, very important question. If you're responding, if the client comes to you as the professional and you get a letter, whether that letter's correct or requires a response, there's no one size fits all. So when I get this type of a question, I say, well, if you email me, tell me what the letter is. If it's a let's say it's a garden variety, late filing or late payment or late deposit penalty. Well, as most of you know, I would hope, we do have an administrative program called First Time Abate, which if the taxpayer has a clean paying and filing history for the past 3 years for that type of tax, normally that can be abated once you get through to the practitioner priority service. You'll need disclosure authority. You'll need probably a power of attorney, but it can be done. So if you ever have any questions about whether you should respond by mail in the environment we're in, I would ask that you reach out to me via email and we can chat. Howard asked a political question, or actually a legislative question. Any buzz inside the IRS regarding the possible retroactive increase to the SALT cap limit? There's no buzz inside the IRS. We'll wait to see what Congress does. There's considerable buzz, and was part of the grand debate, very interesting tax policy debate involving so-called red states, blue states. I stay out of that, but Howard, no changes at this point other than those options for pass-through entities, which I think Jay Brower has discussed for some taxpayers. Mark is asking about getting a EIN online, and he said, kept telling you they could not provide the EIN, forced to fax it. Everyone should be aware that there are certain categories of EINs that cannot be obtained online. Some of those restrictions we don't share publicly because cyber criminals would like to get EINs very easily online. Some involve decedents, some involve trusts. Sometimes if I'm talking or with a CPA who's attempted to get the EIN online and they tell me who it's for, individual entity or disregarded entity, I can look internally in sections of the manual to tell them why they may not get it or what they might have to do to try again on the online EIN. Howard's asking about the identity protection PIN renewal letters not mailed to voluntary IP PIN enrollees this year. That's a great question, Howard. So we have 2 IP PIN programs. One is for those who have been victims of tax-related identity theft. They filed the form 14039, the identity theft affidavit, usually with a 1040, and then we have a special unit that processes those. By the way, they got several 100,000 more of those forms 14039 in the past year because of various forms of identity theft involving unemployment compensation, maybe child tax credits, whatever. So those people who each year get, after their form 14039 is processed to completion and a marker is put on their account, they automatically in January get the CP01A each year. Those, though, Howard, who opt in, they do not get a letter. They have to go into their IRS online accounts which is the primary way to opt in voluntarily and then get their new IP PIN for 2022. Jim Newhart's asking about breaking out stats between 1040X and 1045. We don't do that, Jim, on the Mission Critical page, but I'll tell you, I'm looking at a Journal of Accountancy article from Monday that picked up on a GAO report on the processing of 1139s and 1045s, which obviously surged during the pandemic. And we felt normally those should be processed within 90 days. I think there's a statute requirement. We had not been meeting that. As a result of the GAO audit, it's more like 165 days. And this, again, goes to the fact that those are paper submissions normally, and the IRS really has to catch up with those, because as is the case with the employee retention credit on the 941X or the 941, businesses are waiting for that money. Now, fraudsters submit fraudulent 1045s, not many 1139s, but 1045s, 941X. So we're working on that. The Howard's always good for great questions, Karen. He asks, when will we get the 6475 letter? I'm very happy you brought that up, Howard. So let me just level set here. The 6475 letter is going to taxpayers who received EIP 3. Those began to go out late March, within about 10 days after the passage of the American Rescue Plan. So those letters just started going out end of January. What I saw, and it was a bit of a surprise to me, because they don't tell me everything, but those letters are going out on a staggered basis. That was the case with the child tax credit letters, the 6419s. However, Howard and everyone, those letters may be going out on a weekly basis through February and into March. So be careful there. And there are going to be many more millions of 6475 letters, because so many more people got EIP 3 than the advanced child tax credit. It's a larger population. So Karen, I think this is where I come back to your observations earlier. For that recovery rebate credit on line 30, you have to be very careful. If you know a client who's returning to you, who you know they were eligible for EIP 3, Karen, I don't give advice, don't insist, but my recommendation is wait until they bring that 6475 letter to you. Would you agree, Karen?
Yeah, that's fine.
Hi, Ron Weiner. Good to see you're attending today. We'll get you PDFs of the materials. Anna, this was Jim, that guide you mentioned dealing with the IRS, the AICPA guide. A couple of things I want to get down here. CP80, and then Joel's asking about the 8752. Joel, I asked a follow-up to you. You might want to email me, Joel, with more particulars on that form 8752. Off the top of my head, I don't even know. I think it's a guilty form, an international form, but you and I might have to discuss that. Howard's asking about the K2 and the K3. It's so new, and the new IRS guidance, I think and I posted there, Howard, we put out in January and these were approved, probably not only approved by council, but probably council told IRS, put these out to provide more clarity on K2 and K3 reporting. This may be an emerging issue. And Karen, if I have any more information on the K2, K3 reporting, I'll get back to you. Scrolling through, I mentioned the blog. That's the National Taxpayer Advocate blog. I provided a link, www.taxpayeradvocate.irs.gov. You can see all of her blogs there. They're recommended reading. Really, really are, because they're her perspective on IRS operations. The quick program is quick alerts. That's that e-subscription service. Just go to irs.gov and type in quick alerts, and you can go to several links for information on signing up. Stuart Katz. Stuart, hi, Stuart. You asked a very interesting question. When we reopen e-file, which we did on January 24th, you can file the current year, 2021, along with 20 and 19, but you can't go back further. So you could have clients still open to claim a refund on the 2018 year. The statute is still open, but you can't e-file. I don't know, Howard, Stuart, I assume that's a technology limitation. I've never really been asked that question before, but I'll look into it. It's a very, very good question, because in this environment, if you had a non-filer coming in and you do, prepare accurate returns, claiming refunds, it is crucial you get them in under the statute. So if you can file 19, 20, and 21, 19 and 20, and then this year, 21, e-file, great. But you can't file 18. So to Karen's point earlier, probably you'd want to send in that paper return, certified mail, return receipt accepted. Or even if the refund was significant, make an appointment or have the client make an appointment to go into an IRS Taxpayer Assistance Center. But good question, Stuart. Howard, I sent you an email. You submitted a 2019-1040 with the form 1310. That's the form to claim a refund on the decedent's return. Hasn't been processed. Howard, I'll assume that was paper filed. Reach out to me via email and we can discuss it next week. Somebody has asked, and Karen, it might have been you, some 1310s.
But, can I expand on that, Richard?
Ahead,
Could you check about the form 1310s? We can't get them e-filed. They keep rejecting them.
Some 1310s
And I think
can be e-filed. Most cannot. Now, I can go in and look at the business rules for 1310s and email you, Karen, those 1310s that can be e-filed. They're very limited.
Well, Jay had a
The
good
1310
idea.
is never. The 1310 is one of my least favorite forms. I've been here around so long, I get comfortable with certain forms and I hate other forms. The 1310, and Karen, one of your favorites, the Form 56 is not a favorite of mine, but it's increasingly being used. That's the form for a fiduciary to step into the shoes of the taxpayer. Both of these forms, I never have, to me, and if it's to me, I'm sure it's to you, convoluted instructions. But Karen, I will send out to you information on the subset of 1310 forms that may be e-filed. And I'll look at the reject codes for those that cannot.
Yeah, because
But
the problem
let me
is
stick
that
with
they added another ID number to the form.
I'm sorry, Karen?
So we're wondering if that's what the reject. They added another identification number to the form, but maybe that's the reason for the rejects.
On the 1310?
Yeah.
I
So
got to
it might be an
I'll
ID
take a look.
filter where they want to. Yeah.
Let me take a look at the latest revision and compare it line by line to the earlier one, and I'll get back to you. By the way, Karen, does the PICPA capture all of these questions coming in? Do they have that ability?
Yes, I was able to get them from last year. They did for last year's program. And I asked them to do it for this year's.
Okay,
So we'll
let's
have a
hope
copy
so,
of the
because I
questions
would
and
like.
answers.
Yeah, a couple of attendees asked for copies of the questions. So Karen, let's while we're on, I mentioned the Form 56. The Form 56 can only, unfortunately, be mailed to the IRS, cannot be faxed. It requires evidence that the applicant has the legal authority to act in a fiduciary capacity, and that fiduciary capacity could encompass a number of things. It's not just for decedents. It could be for those, Karen, who aren't, might have some sort of power, non-IRS power of attorney to let somebody else handle their affairs. But they're crucial. The Form 56 is crucial to be processed in those situations, Karen, where you are being asked by the executor or the court representative to handle an IRS matter. Because then once that 56 is processed, they become, pardon my wording here, they become the decedent. They have the legal authority to execute a power of attorney for you, Karen. So it's really a two-step process. And even if you had the 56 completed and a power of attorney signed by the fiduciary, I have heard recently that if time was of the essence and you were calling the practitioner priority service, maybe to get transcripts, they would push back and not give it to you unless that Form 56 had been processed by the IRS. So then we come back full circle.
Well, that's the problem.
Unfortunately,
How do you get? There's a 56
we
form
come
that
back.
hasn't been processed since November 2020,
Yeah, so-
and they're saying it's still in processing. Where's the phone number? Who do you reach to find out what the status of the processing?
They're really,
Because November
unfortunately,
2020 is a long time ago.
Who is telling you that the Form 56 has been received and in processing? Because I don't think Practitioner Hotline would see it in processing. I don't think they would see the marker
do.
until it has been processed.
They did.
So
Yeah,
no good
they're
answer
saying
here,
it's
but
in
we have heard that question from multiple sources, and I'll take it back again, Karen. Excellent question. Because you're dealing now, unfortunately, and I'm hearing more, for many years, Karen, I don't think many CPAs were familiar with the Form 56, but as older clients unfortunately pass away, they're dealing with these issues now. So just wrap up here. A couple of questions. See any other interesting one there? Because then we have a lot of your questions, Karen, came in ahead of time.
I'm more concerned about the ones in the file because a lot of anything that was in the questions beforehand, I put in materials if you wouldn't get a chance to deal with it today. So
Okay.
Let's do the chat box first.
Okay. So again, feel free to. Laura is asking for a power of attorney. A CAF number is required. How do I get a CAF number? So, and Karen, you provided the. Let me make sure. I'm sure it's fully correct. So the first time.
Oh no, it's
you as a
off the top of my head.
So this is Dolores' question about how you get a CAF number. The first time a Circular 230 practitioner, and we all know Treasury Circular 230, which governs, which are the Treasury regs governing practice before the IRS, they apply to CPAs, attorneys, enrolled agents, and annual filing season program participants. The first time you ever submitted 2848, and it is processed by the CAF unit, you get a letter saying this is your CAF number. And that number, so you only get it, as Karen pointed out, after you submit the 2848. Now, I come back to the Taxpayer Advocate blog of January 19th. So if you go to taxpayeradvocate.irs.gov, you can see all of our blogs. And the blog of January 19th is headed, "The IRS has not processed my power of attorney. Should I submit another?" So please don't, if you faxed in a power of attorney to the CAF unit, we ask you, and the CAF unit has asked people like me to request of you that you don't submit subsequent 2848s for the same issue. So in the blog, she said, in fiscal 2021, the CAF unit received over 800,000 more authorizations, and they processed over 4 million in fiscal 2021, an increase of over 1 million from the prior year. So they are backed up. The CAF unit is one of the most frustrating units for people like me because we rarely get an analyst or a senior manager to come on they're always invited to come on our internal calls where we can pepper them with questions. So I can hear from the identity theft unit, from the return integrity unit, from the Office of Professional Responsibility, from the advocate herself. But it's very frustrating for me to find out, and in that mission critical page, and the advocate is right when she says they don't provide any updates there. So this is why, in the longer term, once you have a CAF number, we hope that you start to look into using a Tax Pro account along with your client having their own online account to fully digitize the preparation and the transmission of disclosure authorizations. So that's a topic for a full hour, and we have had national webinars on the Tax Pro account and online submissions of 2848 and 8821. And if you can't find them after you search under video portal, if you email me or Karen, if I can email you the links, and if they had time, maybe not until after tax season, you could watch the director of practice talk about these products. She did 2 national webinars on this. So that, Laura, so you get a CAF number, as Karen pointed out, when you file your first 2848. And then we have some questions Matt answered, the remote, a lot of interesting questions from Matt and Jay today. So Karen, I think that's all I see. But
well, the big one from Andrew, what's your recommendation when we have to fight something, you're coming up against a statute, the IRS, it is not responding.
You have to tell me
what's your...
You have to tell
advice?
me what the issue, I need specific information. And these are the types of, if I get an email like Andrew's, I'll email him back, say, I can't resolve this via email. Send me an email, let me know a good time for me to call you. We'll look at a mutually convenient time. Please have any and all IRS correspondence in chronological order from latest to earliest. I'll ask you questions about the client's history, because sometimes the question that comes to me when I unpack it, it's a new client, they've inherited a problem. So Karen, there's no one size fits all, but I could be a resource to point you in the right direction. But there are many instances where, you're dealing with maybe putting a hold on notices. You might be dealing with a deficiency notice that requires, again, their professional responsibilities. So I need to know where we are in that process, Karen, before I competently.
I was just concerned that because your email you said is like a fire hose.
Well, let me address that. And there are some people attending today who may still be waiting responses, and for that I apologize. I'm getting better. The pandemic has forced me to create all sorts of folders. So I have a PICPA folder. So if you email me, let me know if you attended Karen's February 3rd event. Let me know your PICPA member. I like to know where you heard me or saw me. Make it succinct. Sometimes I get emails, Karen, that are a page long, and you need a literary editor to unpack it. So if it's a long case, I don't need the whole case. I don't send me any client information unless I were to ask for it. And we'll go from there. But if we need a call, I will call you back. And Howard, that includes you, my friend. And then somebody is asking, and this, Seth asks, will there be a portal for business correspondence? That's a great question. And that really goes to the heart, Karen, of what we're trying to do with, again, once we get sufficient funding to expand significantly digital mechanisms, both for taxpayers and their representatives. The large business and international unit, and I think we got a question beforehand, does have a portal where the taxpayer or the rep of the taxpayer can request video conferences, but it's only for LB&I. It's not yet for SBSE. Karen was invited, along with a couple of other folks attending today, to a meeting at the IRS Service Center at 30th and Market in the fall of 2019 to meet with the leadership of the office that had been created to begin the strategy, to craft a strategy to implement the Taxpayer First Act, which was passed in July of 19. Now that office, and I think I have some slides in the material, Karen, is now rebranded IRS Next. Karen and other CPAs and also tax attorneys, enrolled agents, they were all invited by me, and we had a very frank dialogue, and they took those back. They did that around the country. I know the AICPA is watching, but to some degree, the pandemic slowed all of that down. We would have moved forward with many of these implementation, Karen, if we had the funding, because the Taxpayer First Act was an unfunded piece of legislation. So we issued a report a year ago as to our vision for implementing it. But right now, frankly, I'm waiting to see what happens if we get a full year fiscal budget, Karen, because only then I think we can move forward aggressively.
Well, Rich, I know we had at a separate IRS, or it was a liaison meeting, or no, I think I was just invited to the appeals division that we had. Remember that meeting with appeals? They
Yes.
talked about having a portal just for appeals, and that was the rollout. Is that going
well,
ahead?
that's one rollout. Now, I'm glad you mentioned appeals, Karen. Now, appeals has come to us recently, and they're asking in this year. So the event that Karen attended, I think it was a year ago, Karen, I reached out to some of the leaders in the tax pro community to come in on a video conference or Zoom. I forget, it might have been Zoom, using our Zoom platform. And the two leaders there, the Director of Appeals, Andy Kiso, and his deputy, Leah Colbert, whom you met, Karen, at that Taxpayer First Act meeting at the campus in fall of 19. They wanted to hear about appeals issues. And that meeting got some of you subscribe to a blog called Procedurally Taxing. It was set up it's a great blog, set up by Villanova tax attorneys. If you need the link, email me. And they reported on that meeting. But Karen, to your point, appeals wants to look for opportunities at liaison meetings this year to come back and further the dialogue. So after tax season, Karen, I believe I'll have an opportunity through the Pennsylvania Liaison Council, which I coordinate, and you're on there. Damien Gasperi has been on there, but there may be new members of the Federal Tax Committee. Ron Wiener's a member of that, to have that dialogue with appeals. So appeals is backed up too. Occasionally I'll get an email, I got one this week, for somebody who had attended another webinar I gave recently who had an appeals protest that they submitted. I think it was a collection due process protest, hadn't heard anything. So appeals does have a customer service number where you can call, leave some information on an appeals protest that has been entered into the inventory. So you can find that on irs.gov. I can send it to you. But appeals, like everybody else, Karen, they're all working remotely, although those appeals settlement officers and appeals officers, they were better situated to do telework when the pandemic hit than, quite frankly, were the people who handle telephone calls, correspondence exams, CP2000s, whatever. So, Karen, I'll keep you abreast on opportunities for meeting with appeals leadership this year.
Okay.
So
Linda experienced problems that we've had too. A lot of us are just getting cut off on the practitioner priority line. I had one agent check in every 9 minutes. Is there like an automatic cutoff if you're not finished at a certain period of time, or
there
it
is
wastes everybody's time when you're cut off?
Yeah. So if I understand the fact pattern, Karen, you call the practitioner hotline, you press one of the prompts. Let's say prompt 3 for individual account, 2 for individual accounts. You get into the queue. You listen to that nice music, soothing music. It tells you what the wait time is. 15 minutes. If it were me personally, if the wait time was more than 30 minutes, there's a possibility that you could be disconnected while you're in the queue before you speak to someone. Or Karen, you
No,
could be
this
offered.
is when we've gotten an agent. We get an
Right,
agent, we're
right.
in the
So
middle of it, we're almost resolved, and then we get cut off.
well, I don't know why that happens. It may be operator error on the agent's part. They do not have the ability, though, unfortunately, to call back. They're not tracking the number they're getting. They're just going to get the next inbound. So you do want to write down the name and the badge number. Now, if you are disconnected or if you're treated rudely and you have the name and the badge number, and I hope it's very rare that you're treated rudely, but if you are, and you were to email me the name and the badge number and the date and the time you called, we have the ability, myself and my manager, to reach out to the manager of that customer service representative. They record those calls and save them normally for at least 30 days. So they would use what's called contact analytics. So they can listen to the call, listen to both sides of it, and you would get a response. But we would need to know the name of the assister, Karen, and the badge number.
Yeah, we sent one of our listserv people had that. I don't know if they reached out to you, but I've had the opposite because I've been nice and I've thanked them for staying on the job and not quitting. I've gotten the agents to do as much as they can for me. I mean, they've been great.
Well, they're human beings too, and a little, and you don't have to be overly. When I hear that a IRS agent, generically call them all agents, is nice, that's great. My concern is that they're competent and that they address all of the issues. So they should be doing that in a pleasant manner. They're trained on telephone techniques. They should never be rude. They should never threaten. But if they ever do, action can be taken if we know the name and the badge number, at least to investigate that call, if you do it timely. Now, Karen, I do want to mention
the one
we
from
are
e-services
expanding.
was yeah.
The
Telling me
IRS,
get these people to use credit cards. Don't use anything else. So that was helpful.
well, hold on here. She was telling you to get clients to pay via credit card?
No. When they're trying to, to set up these accounts with the e-services, it's faster and
Okay.
they'll get them better with credit cards because otherwise you need an Experian account. I put all this in the resources, and you got to get an
Yeah, but-
unredacted report. It has to be
But we're-
exactly what's on your
we've
Experian
moved
account.
away from
So
that.
it's better to just use a credit card.
We've moved away, but now we are using ID.me, Karen. We are sunsetting
Yeah.
the previous method of authenticating. Now, remember what I said earlier. The Treasury Department and the Congress are looking at IRS, the IRS contract with ID.me. They're looking at that company, which has to undergo all sorts of background checks for their security. What type of information do they capture through these biometrics? So that's an issue that does tie into online accounts and to tax pro accounts. And we'll have more to say on that in coming months. I do want to mention something about technology and phones. You may start to see, or your clients may start to see on various toll-free lines, that they may be offered the opportunity for something called a chatbot, BOT. Is everyone, Karen, familiar with a chatbot, where you can call and say why you're calling and you get a response? We're also expanding for those queues that are where the wait time is long. the ability to leave your name and telephone number, and those calls, Karen, are returned. So callback features are being expanded, and I've heard a couple of instances where practitioners have told me they were pleasantly surprised that they did receive a callback. So watch for that.
Yeah,
All of
I've
this is
used it and
technology.
you've been so nice
Right, right.
because
So
they're
what's
calling
else?
back at their time and they're ready.
Right. Anything else in the text chat here? I don't want anybody to feel they don't have the opportunity to Q&A the IRS. By the way, do they tape this, Karen, at the PICPA?
They didn't used to, but maybe this year they did. I heard Jen say
Okay,
something,
just,
but they don't.
some
They didn't used to.
information shared on February 3rd could be stale by the time somebody watches this afterwards.
Right, right.
So Keith is asking, I'm going back to the top here. Okay, good. I missed the new ones come in at the top. So let me go back to the top, Karen.
Right.
So Jeff hi Jeff. He's asking Priority Hotline. Recently, their fax machine has been faulty. Phone assisters on the practitioner priority line use what we call eFax. Those are those fax numbers with 855. Remember, most of them, if not all of them, are working remotely. So they have to be set up. There could be a bandwidth issue there. Jeff, I apologize for that if you've had that experience, because if you're calling the hotline, you get through, and the power of attorney is not on the CAF file, there's a limited amount you can do if the practitioner hotline phone assister cannot accept your fax. Jeff, I have not heard that systemically, but I do believe you that it could happen on occasion. Ectorina, no, they will not call you back if you're disconnected, but make sure you could ask them. I'm almost certain they would say we can't call you back, but do what Karen does. Try to get as much in as pleasantly. I use that term, Karen, have your elevator speech ready to go. My name is Karen Facer Me. I'm a Pennsylvania CPA. I'm calling on behalf of my client. They got a CP, whatever. I have my power of attorney. I can fax it to you. We'd like you to put a hold on the account, or if it's a penalty, could you consider penalty abatement based on oral testimony? Get that all out there, even if you have to write it down, so that
now you know why I talk fast.
Right, so that they're not struggling. They will authenticate that it's Karen Facer Me. They will, if the power of attorney is not on the CAF file, they'll say, Karen, fax it. Hopefully the fax won't be down. They'll put you on hold, and then you can get your business done. That's if you have to call.
Yeah, there's a key question though that really needs to be answered. Is about the forms 2553s. What options or recommendations for new entities that have filed these, and there's unopened mail. We have no idea if the election's valid, and we need to file a tax return. What do you suggest?
All right, great question. So first of all, the mail's what I'm being told, and what the commissioner is saying, we're opening the mail timely. So the mail is open timely. Somebody routes it. In this case, the 2553s. I think they go to Cincinnati. So then the question is, how quickly are they worked in entity control? And if the IRS, or when the IRS approves the 2553, the taxpayer gets a letter indicating the S election is recognized for the specific tax year. Good. So you submitted that last year. You mailed it in. Karen, I think you can fax it in. And then now it's tax season. So you want to file the 1120S. In my opinion, Karen, you should, if that 1120S is ready to be e-filed, go ahead and file it. I have heard some instances where it's accepted, but I can't guarantee it in all cases. Many attendees may not know that the electronic filing platform for 1120Ss does allow the attachment of a 2553 for the first year of the entity. Were you aware of that, Karen?
Yes. But this was a question that came
So-
in that we put in the materials, but we haven't discussed it yet.
So what happens, and this question has arisen by myself and my colleagues. The let's say the 1120S with the attached Form 2553 for the S election is accepted. So the 1120S is processed, but then the 2553 has to go separately through some mechanism, which I will confess is a bit of a mystery to me, to that entity unit to be processed. Now, if the 1120S was accepted, Karen, and the taxpayer, after, let's say, a month, the client had not gotten the recognition letter, you could possibly call the practitioner priority service to see, once you have disclosure authority, to see under that EIN if the S recognition is there, and then you can request a letter. They have their own letter that they can generate with the S election. I wish 2553s could be filed electronically. It's another one, along with the 2848s. It's where we really should move into electronic filing. So what are the others here, Karen, at the top?
Well, the key for practitioners, though, is to make sure that your program actually attached the 2553. So
right,
that's been a problem for them.
So we want to come back to the CP80 because somebody here. So
That's
Anna's
Brenda.
well, let me stick with Anna at the top here. So LLCs have chosen to elect to file as S corp. We're waiting over a year. I'm a little surprised it's over a year. So again, Anna, I would say again, if the S corp, if the entity's return is going to be filed as an S corp, I would attempt to e-file it. If it rejects, then you might have to get the taxpayer advocate involved or submit it on paper with a copy of the 2553. Stephen is asking about e-filing 74 extensions. So he tried, I guess, a workaround. First of all, I always recommend filing entity extensions electronically. I always recommend that. Why? Because I've dealt with too many instances where paper 7004s are submitted, Karen, sometimes multiple clients in one envelope, and then they go to file the S corp or the 1065 and they get a penalty. That's embarrassing. I've heard excuses or reasons, I'll say, why a 7004 can't be e-filed or they elect not to. Some software charges you an extra fee, but I would discourage anyone in this environment this year from filing a 7004 on paper, just as you file the 4868 on paper. So
what's your opinion with the AICPA advice to us that if you're not getting 1139 processed or 1045s or some of these other things processed, the way to fix it is to send in a check for $1, send it the certified mail, cover letter, payable to U.S. Treasury, apply it to the tax and period as additional receipt confirmation. I've talked to an attorney that you and I know, Phyllis Epstein. She said a tax court judge told her to actually, pay it and apply it to an estimated payment. I mean, are these things that you think will work?
These are all interesting workarounds. First, and Ron, forgive me, I'm not sure I would rely on a tax court judge as august
That's
as
not
they
Ron.
are
That was
to
Phyllis's husband.
provide, no, I know, but Ron would probably smiling now, to provide IRS insight onto processing. I'm not even sure. That comment from an AICPA member, that was on a blog. That wasn't an official comment. That was on one of
No,
the
that's
articles.
in their guide. I mean, they're getting desperate.
Really? Yeah. Well,
Yeah,
we all
we're
are.
all,
We all
we
are.
don't know what to do. We get our job done.
Well, I'll tell you what I would do if it were a significant 1045 submitted last year, early last year, mid-year, or 1139, or a 941 claiming a large refund, and there's been and you've attempted through the practitioner priority service to find out what the heck's going on, I would do two things if it were my client. And this is just me speaking to assist my client. Number one is I'd have to have a power of attorney. I would fax a 911 application for taxpayer assistance order to my local taxpayer advocate office. And they have a guide pamphlet. We used to give it out at the face-to-face working togethers, Karen, with the fax numbers. And I would also consider going to my local congressional office. Every U.S. congressperson, senator, and representative has their district liaison office. Those individuals hear from constituents about issues with IRS, with Social Security, with Veterans Affairs, with government entity agencies. If it's an IRS issue and the congressional office staffer has all of the information, they'll get a waiver from the constituent, a signed waiver, to send that directly to the taxpayer advocate office. Those seem to get a little more priority, Karen. But those are really the two.
Yeah, and the taxpayer. Yeah, Erin in her report was saying that they're getting flooded with those. My concern is I thought taxpayer advocates stopped dealing with those, the 941s, and they're not.
Well, no, they
can't
stopped dealing with the 1040. So sometimes there's a workaround. She said the 1040Xs, not the 941s.
Yeah.
But
1040X.
But they seem within the advocate to track congressional referrals who get, shall I call it, concierge treatment. You don't want to do that. I'm not defending the IRS, but really what we have to do, Karen, and the commissioner knows this. I got an internal long email from my commissioner last night, and all of this noise about the backup in accounts management, submission processing, they just made a policy decision internally. This will be picked up, I'm sure, in a day or two in Accounting Today in the blogs. They've said to employees who in the past 2 years have had jobs in accounts management, but then moved on to other jobs, we now are detailing you back in basically as reinforcements. To use a military allusion, these are reinforcements going into battle, and they will be doing that for the balance of the fiscal year. That's how desperate they are, Karen. So you're hearing it from me first. I hope I don't get disciplined for sharing the commissioners, but it will be out there in the public, this email he sent to the troops this week. So I won't be, I do not have a background in accounts management, so they're not going to pull me from Stakeholder Liaison. But you'll see some, they're trying to get more warm bodies, frankly, to deal with this backlog, Karen. And
well, we're lucky to have you, Rich, and appreciate your honesty.
Some of you may see the Washington Post. The former National Taxpayer Advocate, Nina Olson, speaking on her own, wrote an op-ed yesterday, and it'll be picked up in various quarters. So Nina's proposal, and remember, she's been on the outside now She left right before the pandemic hit. But she's saying, why don't the IRS bring back retired employees? They've got to treat the IRS employees as essential workers, the way healthcare workers are, set them up 24 hours a day, 7 days a week, social distancing, and force them to come back. Now, that's not a big, I'm sure they're considering that, but I don't know if that would have to be negotiated with the union. There might be there are employees, Karen, who just like who in other sectors of the economy, and Jay referenced this in his remarks, do not want to come back into an office, and they may quit. They may get that job at McDonald's or CVS rather than, for whatever reason, come back to the IRS. That is a big issue that they're worried about.
Well, one of
What
her
else do
other
we have?
comments was stopping audits, holding off on audits.
Stopping
Do you
what?
think they'll do that?
Well,
Audits.
okay, so here's what I know and I don't know. I don't know to the extent in the very near future that certain types of compliance activity will or will not be stopped. Now, by compliance activity, I'm casting a wide brush here, Karen. It could be anything from the automated notices right through collection intent to levy, right through to automated collection system or ACS. It could be correspondence exam. All of that is compliance. So there have been suggestions from the AICPA after we issued that announcement on January 27th, which is in the materials right at the top of the IRS updates, saying we paused that CP80. We paused it too late, frankly, but we paused it going forward. The Barry Melancon of the AICPA, and you may have seen this, Karen, says, well, we respectfully appreciate that, but we believe more IRS can do more within their statutory authority. So this, to a large degree, Karen, is a legal question looking at by Chief Counsel. Does the IRS have the legal authority to stop certain types of compliance activity? My guess, and it's only my guess, as of 11:30 on February 3rd, is we will be having some more announcements in the near future. But I don't know yet, Karen, what those announcements will be and what pipelines, if you will, of compliance they will impact. So stay tuned. It's going to be interesting. But so there is that debate as to what we can pause legally. I mean, when the pandemic hit, the commissioner, and he said this, I think, to the PICPA at TaxCon in November, he was the first commissioner ever to shut down the IRS. So he shut down the IRS, literally shut it down in March of 2020. We continued to have electronic processing of tax returns, but even employees like me who were enabled for telework, we were not teleworking until April, May, and then it was a bigger lift to get thousands more employees who had never teleworked with the computers, with the technology. We use secure portals, virtual private networks, to access all of our systems, to do all of that. So all of that created a mess, which we're still digging out of. So what else? I want to come back to CP80. So let me hold on here. So if you have a CP80 that the client got, received, I should say, and if they made a payment, which is credited account, which is generating the CPA, Brenda, it says she has guidance in quotes. So it's not legal guidance, but my advice, Brenda, is don't send in a duplicate return. Wait for them to catch up. I'll assume this is if you have a e-filed return that generated a CP80, which I have not heard about personally, but if it were to happen, then I would, using checkbox authority, if you have it, call the practitioner hotline to find out what's going on. Because an e-file returns accepted, in most cases, should post to the taxpayer's account pretty quickly, unless we are reviewing aspects of that return downstream. But for paper returns that have generated CP80, is the credit, I would not send in a duplicate. And I would not send a dollar return with a 1045 or 11. I wouldn't do that, Karen. Sorry.
No, well, I'm just telling you what advice is out there for us. And
yeah, no, I'm
warning
happy
you
that you did. You know, and feel free, tell them, you know, you were at an event with a stakeholder liaison, and he was, shall we say, a bit dubious about that advice. Can you have any? I would like to know more to unpack that as to why he thought that was a good thing to do. So what else do we have, Karen, in there? What else? Anything you want to bring up?
The main thing about dishonored checks, what's your advice about those? People have asked about that.
So why was the check dishonored? Was it insufficient funds?
It hasn't been processed. It's over 60 days in processing, and you know, the banks, you know, it's not. It has not been processed.
Well, I'd have to know where.
It's a dishonored check.
So it wasn't dishonored. A check. I can't find that in the text chat, but maybe the check was
the IRS.
mailed.
Evidently, clients have, or these people have experienced that the bank, when the IRS submitted it to them, the bank dishonored it. So it's too old.
Well, then, did they get a letter from the IRS? I'd want to know the letter. If it was a letter saying we could not deposit.
I don't know.
Sometimes, you know, there are if somebody sends in a check and for whatever reason, the day the IRS attempts to, negotiate that check, the funds aren't there. They gets a letter. They can resubmit that. If the funds then are in the account, if they get through to an IRS accounts management person, my understanding has always been that they can attempt to deposit that check again. Wherever possible, we are encouraging electronic payments, particularly by direct pay, electronic funds withdrawal. Karen, even outside of the pandemic, the number of lock boxes, those are those PO boxes, those are gradually contracting. They're still important if the client insists on writing a check. If we ask that you send it to a PO box, please do that, because those payments get processed and go to the Treasury much quicker. But Karen, let me ask you, for any millennial clients, do they even write checks these days?
No, they want to pay everything online. That's why they're going to have Venmo problems when they get 1099s.
Right. Karen, I think we're up against 11:30.
Yeah, we're up against the time. So I did want to mention about the practitioner priority service line. They've stopped dealing with short-term payment plans and installment plans. SBSE is doing that. Is that a long-term policy, or is it just through COVID?
Yeah, thank you, Karen, for that. So last April, you know, and the IRS is such a bureaucracy, there are negotiations that go between accounts management, which handles the practitioner hotline, and small business self-employed collection, which handles the automated collection services. So they to balance the phone traffic, Karen, last April, a memorandum of understanding was reached between those two separate divisions, so that any call to the IRS that involves a collection matter, including setting up an installment agreement, is routed to ACS. That is indefinite, Karen, because they want the ACS people to address the taxpayer holistically, look at their whole compliance history, hopefully set them up, reach a collection resolution. But that is ongoing. So if you have a client who got a bill and they want to set up an installment agreement, and they don't want to set up an online account to do it without contacting the IRS, which in most cases you can set up an installment agreement online if you have an online account. But if you don't want to do that, if you call PPS, you want to press the prompt for ACS and get into that queue, Karen. Because when you get into that queue, it asks for the social security number. So when the ACS assistant comes on, they're trained in collection resolution. They then can cut to the chase and hopefully get a resolution. So that is, I'm glad you mentioned that. That was back a while back. And Karen, we will hope that the PICPA captures these questions because they're useful for me for a variety of reasons going forward.
Yeah, I'll follow up on that. Can you flip through our slides so that Matt and Jay can come back on? And while you're doing that, the only thing I wanted to say is the most important that I've been pushing Peter Carcara and all the congressmen is to give us 100% Pennsylvania NOL write-off. Our clients that have to sell businesses are really hurt because they can't, the year of sale, they have a big gain, they have to pay tax, they can't use, all but their, they can only use 40% of their NOL and they'll never be able to use it again. So, contact your congressman, PA. And also, if you missed Matt's great Philadelphia program, I did provide links in here. PICPA provided links to that. It was a great Q&A he had with Frank's team. It was really great. And so that's in here, too, if you missed that. And the same with the Pennsylvania. Okay, up to Matt and Jay.
Karen, is this the slide, Karen?
Yeah, well, go to Matt and Jay's slide. I talked while you were doing slides. So, yeah, go to Matt and Jay's slide.
So is it after Seth?
Don't worry about it. Just get rid of it. Go to Matt and Jay's. We need to cede them time. But thanks.
Yeah, I'm trying to get there. I just don't know where. I'm scrolling forward, right?
Yeah, you're
going the wrong way. Try to go about over to slide like 150 or something like that. We're probably over there. I'll work the slide deck from here. We'll get moving. So thank you, Rich. Thank you, Karen. It's good to have Rich on here. I mean, it's great to have this event where we get Rich to answer individual questions from our attendees. Even though it's in a virtual format, it's still great to have him here. All right. All right. So Matt and I are going to pick up right sort of where we left off on our SALT discussion. And this topic is something I think a lot of you want to be aware of as to what's going on out there. As all of us know, if you do individual taxes, after 2017, you have this $10,000 cap on the amount of state and local income and property taxes you can take as an itemized deduction, and that upset a lot of people in let's call them blue states with high tax states like New York, New Jersey, California. And in 2018, the state of Connecticut, I guess they have some smart people living in Connecticut, and their legislature came up with a pass-through entity tax, which is an income tax that's directly imposed on an S corporation or partnership that's doing business in Connecticut. So if you can imagine, they almost treat the pass-through entity as a C corporation. The entity pays a tax. It's a little under 7%, the rate. And what the other mechanism to this is at the investor level, whether they're an individual or a corporation, it could be another partnership or another pass-through entity, that a portion of that tax payment made at the entity level flows through as a credit. And so imagine you're a partner in an accounting firm that does some business in Connecticut. You get a K1, you get a Connecticut K1, which says, okay, so much of your income, this much was taxed by Connecticut, and this is your share of the tax that was paid to Connecticut. You can file a Connecticut tax return and use that or at least a portion of that tax paid by the entity as a credit against your personal Connecticut income tax. So Connecticut was the first state out of the gate with this. Now in Connecticut, it's a mandatory tax. You don't have a choice. If your pass-through entity has nexus there, they've got to pay it. In 2019, a few other states kind of jumped on board with this. They looked at what Connecticut did. They said, that looks like a good idea. Because what this does, at least what the thought was at the time, and it's since been confirmed as we'll discuss, is that since it's an entity level tax, it gets deducted by the entity itself. Think of your 1065 or 1120S. It gets deducted on the tax expense line right there on page 1. It reduces page 1 income, reduces K1 line 1 income. It's not an itemized deduction, not subject to the $10,000 SALT cap. So we've moved what would ordinarily could have been an individual tax subject to the $10,000 cap. Now that's been moved up to an above the line deduction. So I said Connecticut passed this in 2018. In 2019, a few other states, New Jersey, Rhode Island, there's one or two others in there. I think Maryland might have been one. They passed some taxes as well. It's sort of along the same line. The entity pays the tax. The investors get a credit against their personal tax for some or all the tax paid at the entity level. Most states, they get a credit for all of the tax that's paid by the entity. But what these other states did was they didn't do it like Connecticut. They made it an elective tax. So the entity must make a formal election with the state revenue department that says, yeah, we essentially want to be taxed as a C corporation for this year. So again, we've got a handful of states now that passed these taxes. In late 2020, the IRS put out notice 2020-75 that addressed these things. You can imagine, these what we call SALT workarounds were enacted as a way around the $10,000 SALT cap. Nobody was hiding that fact. And some people were very concerned that the IRS was going to blow these things up. They're going to say, "Nah, we see what you're doing. Nice try, but you got to recast this as some kind of deduction that may flow through and be subject to the $10,000 cap." But that's not what they did. The IRS guidance here is very favorable. It's quite favorable, actually. What the IRS notice says is that, it doesn't matter if it's an elective tax or not. The tax paid by the entity flows through as an ordinary business deduction. Comes through on, they don't say this right in the notice, but conceptually it comes through on page 1 of the 1065 or the 1120S. If it's a rental activity, it could go on Form 8825. But in any event, it's a business deduction. It's a non-separately stated deduction, so you don't break it out for each individual partner or shareholder on their K1. It reduces AGI. It's not subject to the SALT cap. So this is where we are today. Look at the map of the United States here. A year ago, most of the states here were yellow. This is where we are as of just earlier this week or late last week. All those states that are not yellow have some sort of pass-through entity tax. The only one that's mandatory is the one in blue. That's Connecticut. The ones in red, New Hampshire, Tennessee, and Texas, they've always had entity-level income taxes, so nothing's really changed there. But those states, they tax the entity. Those 3 states do not have an individual income tax, but they do tax a partnership. They'll tax a proprietorship, an LLC, almost as a C corporation entity. But there's no credit flowing through to the investors, because the investors don't pay income taxes. The states in green are states like Connecticut where the entity pays the tax, and the tax paid by the entity flows through to the investors as a credit. In most cases, that's a refundable credit. Not all cases. Let's look at, take California. In California, it's not a refundable credit. In California, if the credit exceeds your tax, there's a 5-year carryover of that excess. The states in kind of that dark brown color, those are what we call exclusion states. So let's look at North Carolina. They just passed theirs a few weeks ago. In North Carolina and in these other exclusion states, again, the entity elects in to pay the tax. It pays the tax on its income that's apportioned, usually that's apportioned to the state. At the individual investor level, the investor usually starts their state tax base with their federal either AGI or gross income or taxable income, but they then make an adjustment. They subtract out from it their share of the income that was taxed at the entity level. So you're reducing your state tax base at the individual level by the amount of income that was taxed at the entity level. Therefore, that eliminates the need for a credit. There's no double taxation now. So you see, states are approaching these things in different ways. Oh, and by the way, there's no uniformity among the states here. The states have all different rules as to what the tax base is, how the credits pass through, as to who can elect in, as to how the tax is calculated if you have non-resident and resident partners, if you have corporate partners or upper tier partnerships as partners, maybe you can't pay the tax in for them. In another state, you could. So the rules here are crazy. I mean, these things, and there's going to be more of them. There's I think 5 more states have bills in their legislatures right now to pass these things. Ohio's one, Pennsylvania's one, although I don't know that we're going to actually get it. But these things are all over the place. There's no uniformity. As I mentioned, some states are what I'll call credit states, credit for their share of the tax paid. Other states are exclusion states. You don't get a credit, you exclude the income tax at the entity level from your state taxable income. The tax base varies depending on the states involved. Now, so some of these, the SALT cap, if Congress doesn't do anything, the schedule to disappear after 2025. And many states have provisions in their laws which say, okay, when the SALT cap goes away, our PTE tax, our pass-through entity tax, goes away as well with it. We'll go back to the way things used to be. Right now, Congress is talking about increasing the SALT cap in the Build Back Better plan bill. They talk about increasing it from $10,000 to $80,000. Does that take away the benefit from electing into these taxes? Yeah, it could, sure. What I like to point out, though, is these workarounds, even if the SALT cap were repealed, these workarounds could still have a benefit. Number one, they reduce AGI. So think of all the things that depend on AGI at the individual level. Number two, they'll also reduce, if it's a partnership, service partnership, it'll reduce your self-employment tax base. If you're a passive investor, it would reduce the amount of subject to the net investment income tax. So there are, some potential tax savings available for these workarounds if indeed the SALT cap does get repealed. Matt, you have anything you want to add on a general high level first before we dig into Jersey and some other states?
Yeah, and I'll specifically hold back because I know we have the Pennsylvania residency credit coming up. But to me, the general stuff would be people like choices, right, Jay? So there's some choices here other than Connecticut. You got options, which is good for us. We talked about gray. You highlighted the fact that part of the beauty and some would say ugliness of multi-state taxation is all these differentials you're talking about here, right? It's not consistent across the board, but that's why people like you are valued, right? So to me, the exercise here seems to be, Jay, to roll up the sleeves, get out the old Excel spreadsheet and you're doing your modeling, right? Like you got to do the math problem.
Yep.
What is it worth to us? What does it mean? What is results? And it's like, it's not always like snap your fingers, high level. This is what it looks like. Sometimes you can kind of do that. This one's a little harder. You got to kind of roll it up and get in the weeds. How many partners are there? Where do they reside? Is the credit permitted there or not? And you kind of got to roll through the math problem and say, makes sense for us to elect in these states and doesn't, or we continue to evaluate in these other states. So it's definitely a smoking hot topic, as Jay's alluding to here.
Yeah, Matt, I think I'll advance our slides here. Let's talk about some of the problems with these. At first, it sounds like, hey, this is pretty good, but and we'll talk about a big problem with Pennsylvania here. But you have to look at the states where your investors live. New York, New Jersey, Connecticut, a few other states. They when you get to the investor level, the issue becomes: is that investor eligible for a credit? A resident investor, are they eligible for a credit for a passive entity level tax paid to some other? New York, New Jersey, Connecticut say yes, as long as that other state's tax is substantially similar to ours. And the state revenue department or the state revenue commissioner, tax commissioner, gets to make the determination to which states passive entity taxes are substantially similar to theirs. New York's put out really favorable guidance. They're even saying those exclusion states are substantially similar to New York's. And to me, they're not. But hey, I'm glad that that's what they put out. But what if they don't put out any guidance? Are you sort of left with what do I do when I file my tax return? Some states, namely, I know Pennsylvania for sure, they have statutes on the books that say, no, you don't get a credit for an income tax paid by an entity. So if the entity, an LLC, a partnership, an S corp is paying the tax, but you or Virginia, presumably you're not entitled to a credit here. You've got perhaps an argument under WIN that you should be, but you're going to have to then take that up with the state revenue department and go through an appeals system and all that fun stuff. And how much is the credit we're talking about? Is it $20,000-$30,000? Is it $500? Is the juice going to be worth the squeeze there? These things can create an accounting nightmare for especially a partnership with a lot of partners in those states where perhaps all of the income of a resident partner is taxed, and only the income sourced to that state for a non-resident partner is taxed. I'm thinking New York here. And again, the entity is paying the tax. These tax payments, while they are an expense of the entity, they also have a flavor of a cash distribution because they work their way down to the individual's tax return, in many cases as a refundable credit. So if when you file your individual tax return, you've got this credit passing through you. If that credit exceeds your tax, you get a refund. So you're getting cash back that the entity itself paid. Fourth bullet point here, investment partnerships. This is something that we've kind of struggled with this past year. To think of a partnership, it doesn't conduct a traditional trader business. It pulls investors' money. It goes out and invests them maybe in other partnerships, small businesses, whatever. But it itself doesn't conduct a trader business. Normally, expenses paid by that entity would be portfolio deductions, no longer deductible for federal tax purposes. What if that entity elects into these state PTE taxes? IRS guidance, notice 2020-75 says it's an ordinary business deduction. The notice makes no delineation between traditional, trader businesses, operating trader businesses, and investment partnerships. So, can you rely on the notice to take a position that's a deductible above the line tax versus a portfolio deduction? I can point to regulations which say it's a portfolio deduction. So and I've dealt with some clients where we're talking about big numbers here, and they've got to figure out what their position is going to be on this. Presumably, IRS or Treasury will put out regulations on these, and I don't know if it'll come in anytime soon. But once they do, they may pull back on some of that really favorable guidance that was put out there in Notice 2020-75. Last bullet point here is something I'm now starting to get asked a lot about since our audit people are working on audits, and that is ASC 740, accounting for income taxes. How do you treat these things? AICPA guidance seems to indicate, well, you probably just want to treat them as essentially as a distribution to the owners as an equity-based transaction and not expense of the company. But the whole purpose of this was to make it an expense of the company to get the federal tax deduction. So which one is it, guys? Let's look for most smaller businesses, if they don't issue GAAP basis financial statements, who really cares? But if it's a larger business, if it's a pass-through entity, it issues GAAP financials. Your audit people need to know about this, and how are they going to handle it? What's the disclosure you need to make? Do you now need to throw up deferred tax assets and liabilities? What if you elected into the tax after the year was over? Is that a subsequent event? What do you do? So this is going to make it fun this year with auditors and how to account for these taxes. Let's go to this. And Matt, anything to add on to those issues?
No, keep rolling. I'll jump in a minute here, Jay.
Okay. One thing that's very important, since most of us here today are in Pennsylvania, we have Pennsylvania resident clients. The Pennsylvania Department of Revenue is taking the position that if an individual investor in a partnership, they're a Pennsylvania resident, they are not entitled to a credit against their Pennsylvania income tax for any tax paid to another state by the partnership. Let's take me. I'm personally invested in this. I was a partner in a New York accounting firm last year. I live in Pennsylvania. Well, about 85% of my income gets taxed by the state of New York. When I file, and my firm elected into the New York PTE tax. So Pennsylvania is telling me that I don't get a credit against my Pennsylvania income tax this year for the tax that was paid by my partnership. So they disallowed my credit. So my effective state tax rate just went up by 3%. I'm thrilled. So now this only applies to partners in partnerships. There is a statute on the books that says Pennsylvania does grant a credit where for shareholders of an S corporation. That statute goes back to when states like New Jersey, New York, in New Jersey, there was a time S corporations did not exist. Prior to '93, there was no such thing as an S corp. Prior to '93, and remained on the books ever since. So but what the Department of Revenue is saying is that, well, we see the legislature put in a credit for S corporation shareholders, but there's nothing there that says anything about partners. Therefore, partners don't get a credit, and this could be costly. If you have clients that are being solicited by the partnerships that they're invested in, hey, do you have a problem if we elect into a state's PTE tax? You should be aware of this. You may want to take the position that, no, I don't want them to elect in because Pennsylvania is not going to give me a credit. And it's going to wind up costing my client even more money than the federal tax savings that they would otherwise get. Now, do you have arguments here? I think you do. There's several points that you could argue. You're probably not going to get relief at the Board of Appeals or Board of Finance and Revenue, but this may be a few years down the road. We'll see. Right now, we are working on legislation. I think there is a bill currently sitting in Harrisburg that would, you know, sort of force the Department of Revenue to grant a credit here if that legislation does get passed. That's something that the PICPA we're working with the Philadelphia Bar Association on that to get that language put in. It's a pretty simple fix, you would think, but it's not always easy to get the people in Harris want, even on what may be a common sense thing. Revenue's going to push back and say, hey, if you do that, it's going to cost this much more millions of dollars. So do you really want to do that? Anything to discuss here, Matt, on the Pennsylvania's position?
Yeah, yeah. A few things. Let's stay on that PA slide if we can for a moment. Just
Sure.
people are asking great questions in Q&A, and just to have some fun with it maybe for a minute, Jay. Sometimes the absurdity at least makes you laugh. Like Bill Laser jumped in the Q&A earlier and just commented for people's benefit. Said, "Hey, listen. So Scranton is like the city's doing like a payroll tax, but the school district, they don't really agree, so they're going to do like stay with the business tax. So you have these two crazy taxes, in the same, basically for the same businesses living in the same place. And there was other people, on the New York telecommuting issue. So you're telling me like the government said I'm not allowed to come into the state, right? I'm not even allowed to come in. The employer says I'm not allowed to come in, but you want to tax me on 100% of income as if I existed there? I mean, is it a little crazy? Like if you weren't like a CPA who dug into this stuff and understood, how it gets to this point, you'd say that's the most absurd result. Like here's another one that's like, to me is right in that realm. So you're saying like if you're an S corp, like for all intents and purposes, for I don't know, many 98% of the things or something, an S corp would be roughly equivalent to a partnership, or an LLC tax as a partnership, at least for tax purposes. But here you've got this goofy distinction, right, Jay, that you just highlighted. It's
Yeah.
a critical one to this audience, as many of the businesses in Pennsylvania and certainly of the audience here operate in flow through form. So you're telling me that an S corp gets a credit if you're a shareholder of an S corp, but no one else does. If I'm a member of an LLC, I don't. Or it's crazy. I mean, come on here, right? But the problem is you're in this quandary of gray. You have to make a choice as to what like you highlight some of the areas here. This is one like sometimes you want to pick a fight. Like this wouldn't be a bad area to pick a fight, and maybe there'll be legislation like Jay you alluded to, and maybe the state will enact some laws that fix this thing. But your problem is you got to make a decision now as to whether to elect into some of these states. And if you have PA resident shareholders, which you very well may, right now those laws may not be favorable towards you if you're not an S corp. Mm-hmm. So it may be enough to swing when we do our Excel modeling, Jay. That topic may be enough to swing it towards go no go, the no go decision there.
Mm-hmm. We had a question. It's a great question on the topic from Diane Sokolsky. Sorry, Diane. She asked, can partners elect to be included in the PTE? In most states, it's an entity election. So the entity makes the election on behalf of all of its investors. And if 10 investors want to elect in and not, well, too bad for that one investor who does not to elect in. I know that in California, who has one of these taxes, in California, the individual investor can elect out. But in most states, the investor is going to be bound by the decision made at the entity level as to whether or not to elect into one of these PTE taxes. But I think it's important to know that in most states, for the 2021 tax year, the window is still open to elect in. In most states, you're going to have until March 15th or April 15th of this year to elect in retroactively for 2021. New Jersey and Maryland, two border states of Pennsylvania. Those two states, I know New Jersey is March 15th. I think Maryland is also March 15th. Let's talk about the tax over in Jersey. I think most of our audience is here on the eastern end of the state. New Jersey's tax has been around. This will be its second year. It first went into effect in 2020. Again, you have to elect in one by March 15th of 22. You go to the New Jersey Division of Taxation's website, you check off a box, and you elect in. And once you're in, there is a way to get out of it as long as it's not passed. Once March 15th passes, you're kind of locked into it if you don't elect out. In New Jersey, all of the investors of the entity get a credit passed through to them, whether that investor is a partner, an upper tier partnership, a corporation, even a nonprofit entity. The tax is paid by the entity on all of the entity's profits that are apportioned to New Jersey, and then passes out. For individuals, it's a refundable credit. For corporations, it's not a refundable credit. Can't reduce their tax below the minimum tax. That was just changed via legislation a couple weeks ago, but for years beginning in 2022. We do in the 21, it's not a refundable credit if you've got a corporate partner in a partnership. For 21, partnerships still have to withhold New Jersey income tax from the distributed share of income to their non-resident partners. So think about it. The tax is being paid twice for those partners if the entity elects into the tax. The entity has to withhold New Jersey income tax, plus it's paying it the bait in New Jersey. It's paying the entity level tax in for them, which gives them a credit. So those partners are now going to be having both a withholding credit and a bait credit passed to them. Conceivably, if they have no other New Jersey source income, they'll get that money back in the form of a refund from Trenton sometime later this year. The way New Jersey was administering the law didn't really line up with the way the law was written. They were coming up with some crazy things, and we were looking at the statute like, where are they coming up with this stuff? And I know the Jersey State Society of CPAs, they made some pretty big complaints to Trenton, to Division of Taxation. And Division of Taxation said, tough, we're administering it the way we interpret it. If you don't like it, get the law changed. So they got the law changed. The law was changed just a couple weeks ago, signed into law January 18th. They've sort of fixed a lot of the problems that I think the Jersey Division of Taxation was bringing on itself. So I won't go through all the bullet points here. We've got other topics to discuss, but things are getting better in Jersey. Those law changes just made the tax, I think, a lot more favorable to taxpayers doing business in New Jersey. Again, be aware that if you've got a partner, you could have an issue here with somebody that gives you a credit or not, and may have to fight that. So you might want to, if you've got a partner that lives in Pennsylvania, you may want to, make your case to the end and please don't elect in, or find a way to get compensated for it. Ask for additional cash distribution or more income allocated to them to sort of make it work out. A couple other states I'll mention. New York passed one back in March of last year. It's too late to elect in for New York. New York is the one state that makes you elect in very early in the year. So if you want to elect in for 22 in New York, you got to make your election by March 15th of this year. A question is the New Jersey bait law change effective for 21? No, it's effective for 22. Originally, it was going to be retroactive, and then at the last minute, they changed it, and they made those law changes effective for 22. New York is, again, the entity pays the tax. A refundable credit passes through to the investors. In New York, only individuals get is only paid in for individual partners, and that includes trusts and estates. If you got a corporate partner or a higher tier partnership, no tax is paid in for them, nor is any credit passed up or out to them. In California, they have a SALT workaround too. Again, you have to elect in by March of this year. The entity pays a flat tax, 9.3%, pretty high tax rate. It's only paid in on individual investors. If a partnership has an investor other than an individual estate or trust, it may not elect in. In California, that again, there's a credit that passes through, but that credit is non-refundable at the individual level. There's a 5-year carryover of that credit. Also, California has an alternative minimum tax, and the PTE credit can't be used against it. And you may find that if you have a higher income individual, they may not want to elect into the California tax. That California AMT is essentially a 7% tax. And if their California income tax is say 12%, that 5%, you only get to use the credit against that 5% differential. You may have a lot of excess credits, which they may not be able to use those up in the next 5 years. You could also have a situation where maybe it's good to elect in for 21 and not 22 or even 23, and then elect back in 24. So as Matt said, you got to get out your Excel schedules and start to model this stuff out to see, hey, should we elect into this thing or not? I'm not so hot on the California tax because of the AMT and the non-refundability of the credit, but for some people, it may still be a good idea. All right. So that's the state PT taxes. I'm going to really slide through a bunch of slides here to get to our later topics. We've got about 5 or 6 minutes left. Where's our stuff, Matt? Okay, next thing. Let's talk about Wayfair. Wayfair, we all know it now. If you do anything with salt at all, you've heard the name Wayfair. You know what the case is about. We're not going to get into all of that. But at this point, we have 45 states with a sales tax plus DC. All of them now have some sort of economic nexus going along the lines of Wayfair, or perhaps it's a higher threshold, like maybe $500,000 instead of $100,000. The two holdout states were Florida and Missouri. They passed legislation earlier this year. Missouri's will take effect a year from now, next January. But every other state, theirs is fully in effect at this point. Matt, do you want to discuss here what put some items in here for the audience on how this is now trickling down to other business taxes?
Yeah, I'll go real quick on it, Jay, just and say, listen, the times have changed. For those of you who've been around a while and you think things were a certain way, you got to change with the times here. This is game over, folks. Like, if your company and or your clients, if they have, just to leave it loosely, like 100,000 or more sales into different states, you got to drill into the details of each specific state here. You've probably got nexus for sales tax and for business taxes. The income franchise tax, economic nexus type theory preceded, as most of you are aware, Wayfair. You go back to Jeffrey case in South Carolina in 93, and the Lanco in Jersey, and MBNA in West Virginia in like 2006 and 7. So in some regard, the income tax preceded this. In other regards, now states who didn't precede it are coming out after this, and everybody's just all in on it. Bottom line, if you breathe into a state and you sell enough, there's small business exemptions out there. We're using loosely the $100,000, but it varies all over the place. Small business, you might get off the hook. But if you've got mid-size kind of mid-size type businesses or large businesses, you're going to have nexus in a bunch of places. We'll get to 86,272 at the end. That could possibly be an exception, but that's a real thin line there.
Okay. All right, Matt, thank you. Next topic is the state implications of COVID relief. So, during 2020, most of us got familiar with PPP loans. There were other, efforts put out there for, restaurants and theaters, things like that. And you have employee retention credits, FFCRA credits, COBRA credits. So all this stuff was put out there to give relief to businesses. I won't go into what the PPP loans were about. Everyone knows about them. That's now gone. Hopefully, PPP is running off into the sunset. Hopefully, all your clients have applied for forgiveness. and have gotten those forgiveness letters. The issue becomes on the SALT side. How do states treat PPP loan forgiveness or the expenses associated? If you remember when the CARES Act was first passed, Congress said, hey, the forgiveness is not taxable. And then the IRS said, yeah, it's not taxable, but you can't deduct the expenses. So you might as well just make it taxable. So later legislation kind of fixed that glitch. And the legislation said, no, the forgiveness isn't taxable and the expenses are deductible. But the states don't necessarily follow federal law all the time. Many states have what we call rolling conformity. So whatever the current federal tax law is, that's what the state follows. Other states, we have what's called static conformity. Let's take California. California follows the federal tax code as it was written in 2015. Here we are 7 years later. They're still going off the 2015 code. Other states, they're looking at an earlier code version. Could be 2018. Could be 2019, 20. So every year they pass legislation which updates their conformity. So a lot of states were challenged here with, how are we going to handle this PPP stuff? And a year ago, this map would have been a lot different than where it is right now. In fact, this map right now is not current. I will say, I put this together back in October, and it has since changed. The state of North Carolina is now what I'll call a green state. North Carolina now follows the federal treatment of PPP loan forgiveness, retroactive to 2020. Before, North Carolina was taking the position that you can't deduct your expenses paid with a PPP loan. Really, the only states of mention here, are Virginia. Only, I believe, the first $100,000 of expenses paid with a PPP loan you can deduct. And in California, the expenses are not deductible unless the business can demonstrate at least a 25% decline in gross receipts for any quarter of 2020 as compared to 2019. So California has their own special rule. You've got to, if you're filing a California tax return for a client that maybe in 2021 they got a second draw PPP loan, how do you know if you can deduct those expenses? And for California purposes, at least, well, you've got to go back and look at your 2020 revenues compared to 19 to see if you had enough of a drop for any quarter to qualify to be able to deduct those expenses. The state of Massachusetts on this map, that's now a green state. Massachusetts just fixed their law or amended their law a few weeks ago. So now they follow the federal treatment. That leaves, Utah. Utah says the forgiveness is taxable, and Hawaii says you can't deduct the expenses. So, most states now are following the federal treatment of PPP loan forgiveness. The other thing I'll mention here is employee retention credits. I think a lot of us maybe you're getting familiar with these now. If you're not familiar with them, you should be, because these things can be very beneficial to your clients if they qualify for them. I'm not going to get into how ERC works. I will just say that there is an income tax consequence to claiming them. If you claim an employee retention credit, the federal tax code requires you to reduce your salaries and wages expense by the amount of credit that you're entitled to claim. And that goes to the period that you earn the credit, essentially the period you paid the wages. So I've got to, so if I've got, let's say I paid, I don't know, I have an example here. I don't, but, let's say I paid $100,000 in wages and I got a $70,000 retention credit. Well, I can only deduct $30,000 in salaries and wages expense on my federal return for that. What about at the state level, though? Most states have a provision that says, hey, if you've got a wage adjustment for a federal tax credit, you can take that as a subtraction adjustment at the state level. Pennsylvania has said for PIT purposes, you do have to make an adjustment. For Pennsylvania, you cannot deduct the credit to the extent it equals the employer's share of the FICA tax. But anything on top of that, there is no adjustment. You can take a subtraction adjustment for PIT purposes. For CNI purposes, I think you're probably entitled to a subtraction adjustment for the credit. But here you've got to look into each state to see what their laws say. It's dealing with, here we're dealing with IRS code section 280C. A lot of that, the work opportunity credit, research credits, those are all in 280C. Those are pretty straightforward. Here we're dealing with a payroll tax credit, though, not an income tax credit. So I think it could be questionable as to whether a subtraction adjustment is allowed in a state that otherwise allows for a subtraction for 280C credits. Matt, if you have anything to mention on that before we move through on that.
No, I'm going to pass, Jay, in the interest of time.
Yeah. Okay. All right. Next slide here. Just a quick discussion on residency. I get calls all the time from clients. Hey, I was talking to my friend, and hey, I've been living down here in Florida, for the past 5 months. If I spend less than 183 days in Pennsylvania or New York this year, does that mean I don't have to pay tax to Pennsylvania or New York? And my question, my answer is, well, that, the answer is always, it depends, right? But, in most cases, no, you're still domiciled in Pennsylvania or New York. Everyone hears this 183-day rule. In some states, it's a longer period, but in Pennsylvania and most of the surrounding states, it's 183 days. Pennsylvania says if you have a home or a permanent place of abode in the Commonwealth and you spend more than 183 days in the state for any purposes, whether you're in the house or not, you're deemed to be what's called a statutory resident. So people can, modify their whereabouts throughout the year to make sure they don't spend more than 183 days in the state where they might own a home. Could be a vacation home. Doesn't have to be their primary or principal residence. But there's this other concept of domicile residency, which is a state of mind. It's where you in your head, you consider yourself to be a resident, and we can't open up your head and see what's in there. The state can't give you, truth serum to have you confess as to where you think you're a resident of, but they'll look at the facts surrounding your life. Are you married? Where's your spouse live? Do you have kids, especially young kids? Where do they live? Where do they go to school? Where's your job? Where's your stuff? Where's your car? Your art collection? Your whatever it is, Look at all the things surrounding your life. You'll look at that based on the totality. They'll say, yeah, we think you're a resident of this state based on domicile. Even if you try to avoid being in that state for more than 183 days, you're still domiciled there, subject to that state's income tax. So if you want to get out of that state, there's a lot of things you should do. If you've established domicile there, to get out of it, you've got to disestablish domicile in that state and establish it in another. So I have a whole list of things I give to clients that say, oh, I want to move to Florida, I want to move to Texas, or whatever low or no tax state they want to move to from, which is usually New York or New Jersey. And this is not an exhaustive list by any means. The second bullet point here, if you got a client that wants to move from Pennsylvania, if they've got a home here and they've got a homestead exemption on it, they've got to pull that homestead exemption. That thing will, if they leave that on there, that's just going to crush them. So they're saving maybe $100 or something in real estate taxes by having that exemption on there. It can cost them a lot more in income taxes if they're otherwise really almost legitimately set up as living in another state. So I'm not going to go through all the points here. I just wanted to point that out because a lot of people don't even remember that they have that homestead exemption, and you want to make sure you pull it if you're going to keep your house in Pennsylvania when you move to Florida or Texas or wherever else it is you're going to. Any discussion on residency, Matt, before we move to our final topic?
Just a real quick one. I'll just say nothing new, and totally agree with everything Jay laid out. It's relevant. I would just say it's got heightened relevance in the current environment where people can work and live more freely in certain industries where they want to, right? And you got to watch the dual residency situation where you say, hey, I'm going to go hang out at my shore house. And it's kind of sort of like almost the flip side of what Jay was talking about, where you're kind of trying to position somewhere. You accidentally positioned yourself because you hung out for 7 months in your shore house, if you get my drift, or you're home somewhere else. All of a sudden, you might have domicile in state A, Pennsylvania, and then residency in state B, and you get whipsawed on your interest income and stuff like that. So you got to guard against that too, and just be aware of it at least.
Yeah, last point, I should have discussed this perhaps, but yeah, almost the last bullet point here on the slide. I've got a shore house in Cape May. I moved there in March of 2020, and I was there through September. Hey, guess what? You're a resident of both states now. Now you've got to deal with crediting and sourcing income and all that other stuff. So you can wind up with inadvertently becoming a statutory resident of another state, and and all the headaches that can pose. Now, fortunately, Pennsylvania and New Jersey are sort of friendly. You deal with a state like New York and Connecticut, then no, they don't give credit between them, and so things can get quite nasty up there in some of the other states. All right, last topic of the day here. Just wanted to make mention of the MTC. The MTC is the Multi-State Tax Commission. It's not a governmental body. It's really just a group of states that get together and they try to put out a uniform set of rules or guidelines that states follow in administering their taxes throughout the country. They put out some pronouncements this year, back in August, on Public Law 86-272. Just briefly, that's a federal law. It's been around since 1959. And what it does is it prohibits a state from imposing an income tax on a business in another state if all that business does is solicit sales in the state. Those sales are accepted at a point outside the state and are shipped into the state from a point outside of the state. So it's sales of goods, sales of tangible personal property, not real estate, not services. If you're performing services, you don't get protection under the law here. So, so you get into this concept of what activities are protected. Anything that's selling related and what they call ancillary services are going to be protected. So you send a salesperson in there, they meet with a potential client to sell them something. Maybe they demonstrate the product. That stuff is protected, but once it's sold, now you got to really watch what you're doing. If you send a team in there to install it, too bad, you've lost your protection. Installation is not a protected activity. It's something that's happening post sale. You train the customer. All these things. You go into the state and the customer pays you. They hand you a check. That's collection activity. That's a post sale activity. That's verboten. Okay, so you get on into these things, what's protected, what's not protected, and a lot of this stuff some of it's been driven by case law history. Wisconsin versus Wrigley, a couple decades ago, but now we're dealing with an internet age, right? A lot of commerce taking place over the internet, and products themselves are hooked up to the internet. I mean, you can buy a refrigerator. And I can pull up an app on my phone. I can be on the other side of the planet, and it can tell me what's in my refrigerator and how cold it is. I've got a thing on here that adjusts my hot water heater. Like, I'm on vacation. Oh, I forgot to turn the hot water heater down. And why am I paying for hot water? Well, I can be on the beach and set my hot water heater, right? Well, just like I'm the consumer can make the controls. Well, the seller or the manufacturer might also be able to make some controls. Maybe there's a software update or a fix. They can push that through to the product. Things like that. So again, in August, the MTC got together and they put out, hey, let's start looking at some of these things. How can we start to find out what here is protected and what's not protected? So they came out with a list of items here that they're now saying are not protected. And if you're doing these on more than a de minimis basis in a state, the seller could will be held liable for an income tax there. So, first item, post-sale assistance through an electronic chat or email. I bought the product. I don't know quite how to use it. I go to the website. There's a little chat box. I can talk with a customer service representative via the chat box. That's unprotected, they're saying. That's a post-sale activity that's taking place in the state. I solicit credit card applications. All these items here. I mean, you can read the slide yourself and see what's in there. It's just, I think a lot of us SALT people looked at this and said, gee, I think they're getting a little bit aggressive here on this. This stuff looks, there's no physical activity taking place in the state with most of these, certainly probably all of these activities. So how can are they really overreaching their bounds here? Now, again, the MTC is not a rulemaking authority. It's not authoritative, but the states, especially the member states, are going to start to pick up on this stuff, and they're going to start to incorporate it into their regulations, and probably, they'll sneak it into their audit policies going forward. So, Matt, I know you've got some things to add here on NTC and 86272. So, go ahead.
Yeah, just given timing, I want to be sensitive to people's time here, and I'll just say that if you're hanging your hat on, somebody mentioned in the chat, Joe Nugent, one of the other famous SALT guys, Gary Dean was both mentors of mine here, would say that, like, you're conceding nexus already if you're claiming 86272. It's kind of a way to look at it. So you're already like on thin ice, and as Jay's pointing out, it's getting thinner and thinner, and the states are kind of feeling their strength, having won that Wayfair decision and things like that. It's absolutely a valid position. I know some people, and some of my clients, some people in this market are still taking that position on a multi-state basis. Just better be real sure, and confident and certain of your details. It reminds me of like when Fin 48 came out, like back in like maybe 2008. Once you start rolling up the sleeves, like put yourself in the shoes of an auditor, Jay, right? You start rolling up your sleeves, you look at things, all of a sudden you start finding out some of these boxes may be checked. So you want to do that self-audit before somebody does it for you, and make sure you have a reasonable degree of confidence in your 86272 positions.
Okay. All right. We are done, folks. Sorry we ran about 5 minutes over. I will turn it back over to Karen or maybe someone else on our PICPA team to close it out.
No, I think we're done. I really appreciate everybody's hard work, and especially all those questions that we got from everyone. I will try to follow up with PICPA and see if we can get you the chat box questions and answers. But there again, all the people behind the scenes that did work, we appreciate those as well, like Jim Newhart and Mary Malazito, especially Frank Breslin, and also Matt and Jay, and the whole team that was on here at the PICPA that helped put this together. It's a very difficult program to put together, especially back and forth this year, trying to make sure we get time for the various sections to answer the questions. So that's why we switched over, so that they got a break from speaking and they could deal with questions. So we appreciate your input, and hope everybody has a safe day. I put instructions there for how to flag a fake N95 mask, just in case you have to have close meetings for a long period of time and your client has COVID. We're asked all kinds of things. So we prepared you to be ready for anything, hopefully. So good luck. Have a great tax season, and everybody please stay healthy.